Hello everyone, welcome to JAIIB CIB Prep. In today's video, we'll discuss about unit number 31, contract of guarantee and bank guarantees. So in unit number 31, we'll see what is a contract of guarantee. It is actually defined under section 126, so we'll study about it. Uh, Parties to the contract, basic principles of this contract of guarantee, what are the types of contract of guarantee, uh, what are the bankers' duty with respect to guarantee? What are the precautions bank take while issuing guarantee and while paying a guarantee? So we'll understand all of this. We'll check your progress and we'll do our practice questions. So let's start. So what is a contract of guarantee? Where it has been defined? So it has been defined under section 126 of the Indian Contract Act. So it has been defined under section 126 of the Indian Contract Act of 1872. Just a minute. So what is a contract of guarantee? A contract of guarantee is an agreement where one person promises to fulfill the promise or repay the debt of another person if that person fails to do it. So the main purpose is to protect the creditor if a borrower fails. Borrower is the principal debtor, and it acts as a safety net for the creditor. Now, the contract of guarantee can be oral or written, and in commercial practice, written form is preferred for legal clarity. Whether a contract is a guarantee or an indemnity, it actually depends on the exact words which are used and the nature of the agreement. Now, for the parties to the guarantee, contract of guarantee, so there are actually three parties. Before that, let's understand one more thing. Why are guarantees common in business? So, in many transactions, the receiving party does not fully trust the paying party because they don't know them well or they are unsure about their financial capacity. Uh, and why bank agrees to give a guarantee on behalf of its customer? So, the bank checks the customer financial standing first, and if satisfied, bank issues the guarantee and charges a commission. So in this manner, bank also earns. So bank charges a commission, and this commission actually depends on the security available with the bank and financial stability of the customer. Now let's now understand the parties to a contract. So guarantee involves three parties: principal debtor, creditor, and the surety. So the surety is the person who promises to pay or perform if the principal debtors fail. So this is the person who actually gives the guarantee. Principal debtor. So principal debtor is who defaults in giving the guarantee. This is actually the person on whose behalf guarantee is provided. And creditor or the beneficiary is the person in whose favor the guarantee is provided. So for example, uh, you go to a bank, you visited bank to obtain a loan. Now the bank does not know you, and bank states that I'll give you the loan only if someone else, which is well known to the bank, gives guarantee. So with this bank, say this is bank X. So with bank X, your friend Y uh, deals on a regular basis. So Y is a long-standing customer of bank X, and he's a friend of yours. So you visited Y and you ask him if he can give guarantee on your behalf. So in this particular case, you are the principal debtor, bank is the creditor, and Y is the surety. Now, Section 128 of the Indian Contract Act states that the guarantor's liability, the surety's liability, is coextensive with the principal debtor. This means that the guarantor is responsible for the same amount and the same terms as the debtor unless the contract states otherwise. And there's a 2014 RBI circular. So there's a 2014 RBI circular which states that if the principal debtor defaults, the creditor can directly proceed against the surety without first trying to recover the from the debtor. Basic principles of the contract. So general contract principles apply to contract of guarantee as well, and court does not stop encashment. So basic principles like offer and acceptance, lawful consideration, free consent, competency of parties, lawful objects. So all these uh, principles which are applicable to a contract are also applicable on the contract of guarantee. And court does not stop encashment of unconditional bank guarantee unless there is a proven fraud. So there are actually two exceptions: fraud and irretrievable injustice. Only these two exceptions court stop encashment of an unconditional bank guarantee, else court does not stop it. In guarantee, there are actually two contracts. There is an express contract and there is an implied contract. So, and there is an express contract between the surety and creditor. The surety agrees to pay if the debtor fails. So, there is an express contract and there is an implied contract. Implied contract is between the surety and a debtor, and the express contract is between surety and creditor. Consideration. So, a contract of guarantee must be supported by consideration. It is provided under section 127. The benefit given to the principal debtor by the creditor is good enough consideration for the surety. So, if you give a loan to your friend because another friend, say X, promised to pay in case of default, so the loan is considered is a consideration for the X promise. Liability of surety, as stated earlier as well, it is coextensive. So surety is liability same as the principal debtor, and the surety is a favored debtor. He only pays if the principal debtor fails. So if the principal debtor fails, the surety takes on the position of the debtor, and hence he is also called a favored debtor. The amount includes the principal amount as well as interest and any other charges which are legally recoverable from the debtor. If the surety pays for the creditor, the surety pays, then he takes place of the creditor, and he can recover the full amount from the debtor. The surety cannot refuse payment just because the principal debtor is bankrupt or the creditor has no other recovery method. Even if there is a court decree against both debtor and surety, the creditor can enforce it against the surety without first exhausting remedies against the debtor. Continuing guarantee. A continuing guarantee is a guarantee that applies to a series of transactions, not just a single one. It remains in force until it is revoked or end by an agreement. Why is it called continuing? Because the guarantor agrees to take responsibility for the debt of the principal debtor across multiple future transactions within the agreed limit. And this guarantee continues until it is revoked. So keep that in mind. With respect to revocation, revocation is provided under section 130. So the surety can stop the guarantee for future transactions at any time by giving written notice to the creditor. So future transaction means any purchase, loan or obligation that happens after the revocation notice, right? And purchase made after a revocation notice uh, can be revoked. So the surety will not be liable for those purchases. Death of surety. So normally the death of surety automatically ends the continuing guarantee for future transaction unless the contract clearly says otherwise. And the debts incurred before death remains payable by surety estate. In banking practice, when a guarantor, the surety dies, bank often stop future withdrawals or loans under the guarantee to avoid the future liability. Variance in contract terms. So, if the creditor and principal debtor changes the terms of the contract without surety's consent, the surety is released from liability for future debts. Say you agree to guarantee a loan at 8% interest for 3 years. Later, the bank and the borrower changes it to 12% interest without telling you. Now, you are not responsible for the debt for the next for this new term, and hence you are released from your obligations. Discharge of principal debtor. So, if the creditor and debtor makes a contract to release the debtor without surety's consent, then the surety is also released. This ensures that the creditor cannot make side deals that increase the surety's risk. Forbearance to sue. So this discharge is under section 134 if uh, anyone wants to know. So forbearance to sue. Also one more thing, you don't need to remember all these sections. It is for your reference only. So if you want to study more, you can just go to the Bear Act and you can study these sections. All right, you don't need to remember all these sections. Forbearance to sue. If the creditor delays taking legal action against the debtor, that alone does not release the surety unless there is an agreement that says it will. Surety is right to recover from debtor. So surety can claim his dues from the principal debtor. So if the surety pays the debt, he gets same legal right as the creditor to recover the amount from this debtor, and this is called right of subrogation. For example, if you pay 50,000 to the bank as surety, you can demand the same from the borrower, right? Securities. So, if the creditor has security from the debtor, say pledged shares, mortgage property, in that case, the surety is entitled to the benefit of that security. If the creditor loses it, then the surety's liability is reduced accordingly. Implied promise by the principal debtor to indemnify the surety. So, the principal debtor is legally bound to compensate the surety for any amount paid under a valid guarantee. So, if the surety has paid any amount on behalf of the debtor, then the debtor should indemnify, meaning to say, should compensate or should return the money to the surety. Misrepresentation made by the creditor. If the creditor obtained the guarantee by lying or hiding important facts, then the guarantee is invalid. Co-sureties for the same date. If multiple guarantors guarantee the same date, each pays an equal share unless it is agreed upon. If they have different limits, so each pays equally up to their limit. And releasing one surety does not release the other. Say, for example, if ABC guarantees 30,000 equally, then each pays 10,000, right? A pays 10, B pays 10, and C pays 10. But what if there is a limit? So the amount guarantee is for 30,000. Surety are A, B, and C. So if A has a limit of 5,000, B has a limit of 10,000, and C has a limit of 20,000. In this particular scenario, A will pay up to 5,000, B will pay 10, and the remaining 15,000 will be paid by C. Bank guarantee. So, what is a bank guarantee? A bank guarantee is a promise made by a bank to pay a certain amount of money to a third party called the beneficiary if the bank customer, fails to fulfill their legal or contractual obligation towards that third party. Now, here the customer is the principal debtor, the applicant who needs the guarantee and has some obligation to fulfill. The person or the company who is protected by the guarantee is the beneficiary, the person in whose favor the guarantee is issued, and then the surety, the guarantor, is the bank because the bank has promised to pay the beneficiary if the applicant fails. uh, types of bank guarantees. So there are three types of bank guarantees which we should know. Number one is financial guarantee, number two is performance guarantee, and number three is deferred payment guarantee. So financial guarantee is given when the customer has to pay money or deposit cash for the contract. So instead of paying cash, the customer asks the bank to guarantee the payment. The bank promises to pay the beneficiary if the customer fails to pay. This is common in government contracts where an earnest money deposit or security deposit is required, and it helps the customer to save money for other business uses since actual cash is not blocked. Performance guarantee, this guarantee is about making sure that the customer performs a job or service as promised. The bank guarantees that if the customer does not perform as agreed, the bank will pay the beneficiary. And unlike financial guarantee, this depends on the performance or completion of certain work and not just payment. And the bank usually pays the beneficiary on demand without investigating whether the customer really failed because the guarantee is a separate contract. Deferred payment guarantee will deal with this later in this class. Don't worry about it. First, we'll cover Unit 31, and when we start with Unit 33, we'll discuss deferred payment guarantee. Bank's duty to honor guarantee. Before that, let's understand one more important aspect. So, there are certain important features of bank guarantee. So, the bank guarantee is a side agreement linked to the main contract between the customer and beneficiary, but it is independent in itself. So, although it is a collateral contract, it is independent in nature. Second, the bank usually pays the beneficiary immediately, so there is an immediate payment. Bank takes some form of security from the customer before issuing the guarantee, so there is a security involved. Risk depends on the credit worthiness of the customer and the likelihood that the customer may default. So there is always a risk involved. And bank focuses on documents. So if the beneficiary presents a claim as per the guarantee terms, the bank pays without questioning. So it is document based. Now let's move on to bankers' duty to honor guarantee. So the bank must pay the guaranteed amount as soon as the beneficiary demands it without any delay. The bank's duty to pay is independent of the original contract between the debtor and the beneficiary. This means that the bank does not have to check whether the debtor has done their job properly or whether there is a dispute between debtor and beneficiary. The bank must pay even if debtor claims they have done everything correctly or if there is disagreement about the contract. The only exception is fraud. There is one more, irretrievable injustice. So there are two exceptions in which uh, bank is not required to pay. So there are certain case laws which we need to understand. Number one is RD Herbotel Limited versus National Westminster Bank Limited. Here the court held that the bank guarantees are separate contracts. The bank must honor the guarantee no matter what the dispute between the party is, except if there is fraud. The bank knows about it. The second is Tex Texmaco versus State Bank of India. So the court here held that when a bank gives guarantee on first demand and without contesting or questioning the payment, it must pay immediately when the beneficiary demands it, even if the debtor objects. The third is UP Cooperative Federation versus Singh Consultants. So here the Supreme Court emphasizes that bank must pay guarantees unless there is a fraud. So courts avoid interfering with the bank guarantees to maintain trust in the business. What if the data company is being wound up? So even if the debtor company is being wound up, closed because of financial problems, the bank must still pay the beneficiary immediately upon demand. The bank's payment obligation is not affected by the company's winding up, and the bank can later recover the amount from the debtor company of its assets. Uh, there's a case, Maharashtra Electricity Board versus official liquidator. Here, a company gave a bank guarantee to Maharashtra Electricity Board. When the company was ordered to be wound up, the board asked the bank to pay the guaranteed amount. Here, the Supreme Court held that the bank must pay immediately despite the winding up. The bank can take action later to recover the money from the company's asset, but the bank should pay. Second is when main contract is suspended by the law. So sometimes government laws or notification may suspend the original contract between the debtor and the beneficiary. Even if the main contract is suspended, the bank guarantee remains valid. The bank's promise to pay is independent and separate from the original contract and will not affect by such suspension. The bank must pay immediately when the beneficiary demands. There is a case which will be helpful. SCIL Limited versus Indian Bank. A contractor had a contract that was suspended by the government under special law. The bank had given a performance guarantee for the contract. The court held that the bank must still pay the beneficiary when asked, despite the contract suspension. Now let's understand exceptions when a bank can refuse to pay if there is a fraud. So the bank has clear evidence that the beneficiary is committing fraud. The bank can refuse the payment. Fraud means serious dishonesty, such as forging documents or falsely claiming the money. The bank must be very sure before refusing to pay because it is a very big responsibility. And if the bank suspects fraud but it is unsure, it should ask a court to decide rather than refuse payment on its own. Second being spatial equity or irretrievable harm. So court may stop banks from paying if paying would cause serious unfair harm to the debtor or guarantor, and if the harm cannot be fixed later. This exception is although very rare and only applies if the harm is clear and proven. So in ITech Corporation case in the US after the Iranian Revolution, court stopped a bank guarantee payment because the situation would cause the pair irreparable harm. They could never get their money back due to political reasons. And what should banks do if there is any doubt? So if a bank is unsure about fraud or unfairness, it should inform the customer that the guarantee has been invoked. The bank should pay the amount unless a court stop it by injunction, and if there is a legal dispute, the court will decide and not the bank. This helps keep the trust in bank guarantee and business taken. Now let's understand about some of the precautions which a bank should undertake while issuing a bank guarantee. So when a bank issues a bank guarantee, it promises to pay certain amount of money if its customer fails to meet an obligation to another party. This promise creates a liability for the bank, and to avoid confusion or unlimited liability, the bank must be very careful while issuing the guarantee. There are some key points like amount guaranteed. The bank must clearly mention exact amount if it guarantees to pay. This amount should be written both in words and in figures, so there is no misunderstanding. And the guarantee should also state whether this amount includes interest, tax, charge, or other expense. If it does not specify this, the dispute can arise later. Period of guarantee. So the bank must specify the exact period for which the guarantee is valid. This means the start and end date should be given. The guarantee is only effective during this validity period. If the customer defaults within this period, the beneficiary can claim payment from the bank. If the default happens after the validity period, then the bank will not be liable. Claim period. Even after the validity period ends, the beneficiary needs some time to make the claim. So this extra time given is called the claim period. The claim period allows the beneficiary to prepare and submit the claim if the default happens on the last day of the validity period. Usually the claim period is 15 to 30 days longer than validity period. Impact of amendment to section 28. Earlier bank guarantees had a clause limiting the beneficiary's right to claim payment So 3 to 6 months. If the claim was not made within this time, the bank's liability would end. Now, this was done to protect banks from being liable for very long period, especially since government and municipal bodies could otherwise sue after many years, so up to 30 years. Court had upheld these limitation clause as valid before 1997, but after 1997 this changed. The law was amended to say that such limitation clauses in bank guarantee are illegal. Now, if the beneficiary makes a claim within the claim period for a default during the validity period, but the bank refuses to pay, the beneficiary can sue the bank within the normal legal time, which are 30 years for government and municipal beneficiaries and 3 years for others. This means banks can be held for a very long time after issuing the guarantee, so they must be extra careful. Counter guarantee or other securities, even though a bank guarantee is a contingent liability, the bank should protect itself. The bank takes a counter guarantee from its customer. This is a written promise from the customer to repay the bank if the bank has to pay under the guarantee. And this counter guarantee should cover the amount paid on behalf of customer and any expense related to payment like lawyer fees, interest on late payment, taxes, other charges, etc. And this counter guarantee must be valid until the bank is fully released from the guarantee, either when the beneficiary cancels or issues a no claim certificate. Since the bank takes on a risk, it often asks for additional security from customer, and this could be FD, other financial security, immobile property. And sometimes the bank extends existing charges on the customer's asset to cover the guarantee amount. Now let's understand precautions which a bank should take while paying for the guarantee. Number first, there should be proper invocation. Invocation means the beneficiary officially requests the bank to pay because certain conditions agreed upon have not been met. So, what the bank needs to check before paying is that the demand for payment must be correct and proper. The demand must clearly state the conditions of the guarantee are fulfilled, and the demand should be made within the guarantee's validity period. The amount asked for should not be more than the maximum guaranteed amount, and the person or authority making the demand must be authorized or empowered to do so. Now, there are different court opinions about invocation. So, Delhi High Court views that the demand must clearly explain the reason, like a legal complaint. If it does not, the bank can reject the payment request. The Calcutta High Court views that the demand must be made in simpler commercial way. It does not need to be very detailed, but the bank must understand the guarantees being invoked. And in a case, the Supreme Court held that if the guarantee states that only a person can ask for the payment, then a demand by any other person is not valid, and the bank does not have to pay. The bank has to also check if there is any other court order, any injunction against the payment. Sometimes court stop banks from paying under a guarantee through an injunction order. So the bank, before making the payment, must check if any court order is there for not no payment, and if the bank pays despite such an order, it can be punished for contempt of court. Now let's check your progress. Identify whether the following statements are true or false. So, number one, in a contract of guarantee, the liability of surety is secondary. So, it is actually true. The primary liability lies with the principal debtor. Anything done for the benefit of principal debtor is a sufficient consideration to the surety for giving the guarantee. This is also correct. So, this is also true. Surety is also known as surety, indemnifier, bailer, guarantor, or bailee. So, guarantor. Liability of surety is dash that of principal debtor. It is coextensive with that of principal debtor. Uh, in a bank guarantee, the bank makes payment on dash, being convinced that beneficiary has incurred loss, no. Being sued by the beneficiary, no. the guarantee being invoked after seeking concurrence of the debtor merely on demand by the beneficiary. So this is the best option, and D is the correct answer for this question. In case the company on whose behalf the invoked bank guarantee was issued is in liquidation, the bank should, in this particular case, the bank must make the payment. So must make payment to liquidator, not to beneficiary, must make deposit the amount in court to avoid any controversy, must pay the beneficiary. So bank must pay the beneficiary. So C is the correct answer for this question. The person in whose favor a bank guarantee is issued, he is known as beneficiary. So D, beneficiary is the correct answer. Particularly in this unit, we'll understand what is a letter of credit, parties involved to a letter of credit, types of letters of credit, what are documents which are required under a letter of credit. We'll do some practice questions and we'll wind up this session. So let's begin. In international trade particularly, the buyer and sellers are usually from different countries. So different legal systems, different currencies are involved and very little knowledge about each other's financial position is there. Now this creates a big trust problem. The seller wants to be sure that he will get paid once he ships the good, and the buyer wants to be sure that he will only pay if the seller ships the good as promised. To solve this particular problem, the solution is letter of credit, LC in short. So what is a letter of credit? A letter of credit is a written promise issued by a bank on behalf of the buyer in favor of seller. Now, it states that if the seller provides the required document such as shipping document, invoice, insurance, which are exactly mentioned in the letter of credit, then the bank will make the payment to the seller even if the buyer fails to pay. In short, the letter of credit is similar to a bank guarantee that the seller will get paid provided he fulfills all the conditions. So, a letter of credit works like a guarantee. This general consideration, the letter of credit works similar to a guarantee, though it is not a guarantee, but we can understand it in a similar fashion. And it is not a negotiable instrument like a check or promissory note. It only ensures payment against documents and not against actual goods. So if documents are proper, the bank must pay even if the goods turn out to be defective. Bank is not concerned with the goods. Bank is only concerned with the documents that they should be proper. So what are its advantages? Now, a letter of credit gives advantage to both the buyer and the seller. In case of buyer, there is no need for advance payment. Buyer's money is safe until the documents are presented, and seller is more willing to give credit because a bank guarantee is behind the buyer. Buyers can also set conditions like independent inspection of goods for quality, shipment within the deadline, and insurance, etc. And with respect to seller, assurance of timely payment from a reliable bank once letter of credit terms are met is there. Also, immediate funds can be accessed by the seller, and seller can take this letter of credit and get the bill discounted from their local banks right after the shipment, and they don't need to wait for the buyer to receive the goods. Now, what are the parties involved in a letter of credit? Firstly, we have the applicant, the buyer, importer, or opener. So, he is the person who requests the letter of credit from his bank. Now, for example, if A wants to buy the goods from B, so A is the buyer and B is the seller. So, A will approach the bank and will get a letter of credit issued in favor of the seller. In this case, A is the applicant, the buyer, the importer, the opener, person who requests the letter of credit from his bank. Then there is a issuing bank, the buyer's bank, which issues the letter of credit on his behalf. So this bank, we call it a issuing bank. Then we have beneficiary, exporter, seller. So the person entitled to receive the payment under letter of credit is the beneficiary. Then we have advising bank, also known as notifying bank. So this bank is in the seller's country. So this is in B's country, which informed B, the seller, about the letter of credit issued by the foreign bank. Now this advising bank confirms authenticity of the letter of credit. Then we have negotiating bank, also known as nominated bank or paying bank. nominated bank or paying bank. So, negotiating bank is the bank in the seller's country that pays the seller once documents are presented and verified. So, if the letter of credit specifies a certain bank, say Bank of America, then Bank of America will act as negotiating bank. And so if no bank is specified, any bank can negotiate this documents. Confirming bank. Sometimes the seller does not fully trust the issuing bank. Maybe it's small or financially weak. So in such a case, the seller may ask for a local bank in his country to also guarantee the letter of credit. For this, local bank is called the confirming bank. Reimbursing bank. The bank appointed by the issuing bank to reimburse the negotiating or confirming bank after payment has been made to the seller. So the bank appoint this particular bank is appointed by whom? Issuing bank. So this bank where the buyer approaches. So this bank appoints another bank to reimburse the negotiating or confirming bank after the payment has been made. Types of letter of credit. So there are various types of letter of credit. Let's understand each of them one by one. Number one, acceptance credit. So normally letter of credit requires immediate payment when documents are submitted. So this is also called side bills, side credit. But sometimes what happens? So when letter of credit LC requires immediate payment, uh, when documents are submitted, they are called side credit. And sometimes the payment is not made immediate. Instead, the seller draws a usance bills, which is a time bill, which is paid only on a due date. So this gives buyer the time or the you say credit to arrange the funds. So the buyer has two choices here: wait until the maturity date to get the payment, or get the bill discounted from a bank and receive fund immediately. So time credit where bills are paid at maturity are the acceptance bills, which allow buyer uh, credit from the seller. Irrevocable credit. So only sorry, irrevocable credit is it is once issued, and irrevocable credit they cannot be changed or cancelled unless all the parties agree. So they cannot be amended, they cannot be cancelled. So this gives strong assurance to the seller because the issuing bank is legally bound to honor the letter of credit if documents are correct. And as per the international rules, all letter of credits are irrevocable unless stated otherwise. So they cannot be cancelled or changed unless all the parties involved give their consent. Confirm credit. So in addition to the issuing bank's commitment, another bank called the confirming bank also guarantees payment. Usually used when the seller is not confident about the issuing bank's reliability or the buyer's country risk. Any change in the letter of credit requires consent from all parties, including the confirming bank. With recourse, without recourse. So with recourse is if the buyer fails to pay, the negotiating bank can still recover the money from the seller. So they have a recourse. So if buyer fails, they can uh, ask the beneficiary to you know pay back the bank. So bank can still recover money from the sellers. Then we have without recourse. The seller adds the word without recourse on the bill, meaning that once the bank pays him, the bank cannot come back to him even if the buyer defaults. And as per RBI guidelines, for inland bills, banks should not accept without recourse bills. So for inland bills, banks should not accept without recourse bills. Transferable credit. By default, in letter of credit is not transferable. A transferable letter of credit allows the first beneficiary, the original exporter, to transfer part or all of the letter of credit rights to a second beneficiary. It is useful in cases where the beneficiary is a middleman or trader who does not manufacture the good himself. Back to back credit. So, here the beneficiary of an letter of credit uses it as security to open another letter of credit in favor of his supplier. So, this back to back credit involves three banks: the issuing bank, beneficiary bank, and suppliers bank. Anticipatory letter of credit. These allow the seller to get advance before shipment. There are two anticipatory credits. So they let advance before shipment. So there are two anticipatory letter of credits, red clause and green clause. So red clause gives the exporter an advance before the shipping, and the clause is printed in red. That's why it is known as red clause. And green clause provide not only advance payment but also storage charges at the port before shipment. And this is known as green clause. Then we have revolving letter of credit. It is designed for regular continuous trade between the same buyer and seller. Once payment is made against one shipment, the letter of credit amount automatically reinstates for the next shipment. Now this saves time, this saves the paperwork comparing to issue a fresh letter of credit each time. Documents under letter of credit. So before moving forward to the documents, we should understand the principles which governs the letter of credit transaction. So there are two key principles: strict compliance and independence of letter of credit. Strict compliance states that all documents presented must exactly match the conditions stated in the letter of credit. They should not be similar, they should be same. Even small difference, like experts instead of expert, can make documents invalid. Courts have upheld that almost correct documents are not acceptable. It should be the correct document, not almost correct. It should be same and not similar. An independent principle states that the letter of credit is separate from the main sales contract. The bank only deals with the document and not with the actual goods. So, if documents are correct, the bank must pay even if goods later turn out to be defective. Now, we have a case here: Equitable Trust Company uh, versus Dawson Partners. So, in this particular case, the letter of credit requires certificate signed by experts, but the seller submitted certificate signed by an expert. So, it requires plural, but what was submitted was a singular. Bank accepted, but when the goods turned out to be defective, importer refused to pay. Court ruled in favor of importer because documents didn't strictly comply, right? Almost same does not work. It should be the same and not almost same. Now let's talk about the documents. Uh, Before that, we should also understand banker's duty. So the issuing bank must carefully check that all documents submitted by the seller comply with the letter of credit terms. If the bank accept incorrect documents, it cannot ask the buyer for reimbursement later. Thus, bank are very strict while examining the documents. So it is the duty of the bank to carefully check all the documents which are submitted before complying with the letter of before giving the funds, right? Now let's move on to the documents. Bill of exchange. So bill of exchange is a written financial instrument drawn by the seller demanding payment from the buyer or the buyer's bank. It must match the letter of credit in terms of amount. It should not exceed the letter of credit limit, and the tenure should be clearly mentioned. Endorsement and drawing the parties responsible for the payment. So everything should be mentioned in this bill. Invoice. So invoice is the seller's bill to the buyer showing details of the goods sold. It must exactly match the letter of credit requirements. The buyer's name must be correct. Quantities, description, and value should be the same. So even small differences like wrong units, extra shipment value, excess invoice, this all can lead to the rejection. Transport documents. So these provide goods. This proves that the goods have been handed over to a transporter. The type depends on the mode of transport. So is it by sea, bill of lading, by air, the airway bill? If it is by post or courier, then post, parcel receipt, or the courier receipt. Bill of lading. A document issued by the shipping company when goods are loaded on the ship is a bill of lading. It acts as a document of title to the goods, so the holder can claim the goods. There are certain important requirements that must be shipped on board bill should be there. So confirming goods are actually on the ship. All originals they are issued in duplicates and triplicates. So all originals they must be submitted. Receive for shipment or charter party bills they are not acceptable under letter of credit. Keep that in mind. Airway bills they are issued by an airline as proof that goods have been accepted for carriage. Unlike bill of lading, it is not a title document. It does not give ownership rights, and it is accepted only if letter of credit specifically permits. Post, parcel receipts, and courier receipts. So it is used when goods are sent in small quantities via post or courier. Like airway bill, they are not document to the title of goods. They are just proof of delivery to postal or courier service, and generally goods are addressed directly to the buyer. Insurance document, as it is required in letter of credit, specify goods must be insured. It must strictly match letter of credit terms regarding type of risk covered, amount insured, currency, place of claim settlement, and it must be signed by insurance company, underwriter, or their authorized agent. Then we have other documents. So depending on the nature of goods, the letter of credit may also require additional certificates such as certificate of origin, certificate of weight, quality analysis, health certificates. So depending on the nature of goods, other certifications may be required, and failure to provide any of these means non-compliance and the payment can be refused in that scenario. Uniform custom and practices for documentary credit, UCP 600. So the UCP DC is a set. Uniform custom and practice for documentary credit, UCP DC. It is a set of rules created by the International Chamber of Commerce (ICC) that governs how letter of credit works in international trade. These rules are not laws, but they are widely accepted by the banks and traders around the world, which makes trade transactions smoother and less risky. Now, let's understand about the key features of UCP 600, which was introduced in 2006. So, it was approved by ICC on 25th of October 2006, and it replaced UCP 500. The number of articles were reduced from 49 to 39. New articles were added to ensure everyone understands terms in the same way. So, definition and interpretations are made more clear. Earlier, banks had a reasonable time to accept or reject documents. So now, what is reasonable time? This is a very vague term. So UCP 600 replaces this vague phase with a fixed period of 5 banking days. Banks can now discount against deferred payment credit. That is, they can give early payments. Negotiations were clearly defined as the purchase of draft or documents and not just examination. UCP 600 incorporate 12 articles of eUCP electronic documents which allow electronic or part electronic presentation of documents. This was a modernization step. Payment under letter of credit, primary obligation of bank. So a letter of credit is a commitment given by a bank on behalf of the buyer or the importer to pay the seller or the exporter once the seller submits document that comply with the letter of credit terms. The bank's obligation under letter of credit is primary and independent. So this is very important. This means that bank must pay once correct documents are presented, even if there is a dispute in the underlying contract between buyer and seller. And courts have repeatedly upheld this independence, except in rarest cases where there is proven fraud. So fraud is an exception. So let's understand two important cases: Tarapur and Company versus Tractor Experts. So Tarapur opened an irrevocable letter of credit in favor of a Russian firm for supply of machinery. 25% payment was to be made upfront against the documents and 75% after 1 year. Manufacturing machinery was supplied, but the Indian firm later complained of poor performance and tried to stop the balance payment. They went to court seeking to restrain the Russian firm and Bank of India from enforcing the letter of credit. Now, the decision of the Supreme Court. Let's understand the decision of the Supreme Court. The matter went up to the Supreme Court, and the Supreme Court held that an irrevocable letter of credit is a backbone of international trade. Any interference in its operation would damage India's reputation in global market. The letter of credit is independent of the contract of sale, and court should not interfere except in exceptional circumstances like fraud. So the important principles to be taken from this case is that letter of credit are autonomous, and once opened, bank must honor them. Buyer cannot block payment by raising disputes about quality or performance of the goods. Second case is United Commercial Bank versus Bank of India. So a seller supplied goods under letter of credit. The issuing bank found discrepancies in the document and paid under reserve. Later, Bank of India, acting for the supplier, asked for a refund from the issuing bank, which was United Commercial Bank. The seller tried to stop this refund through court injunction. Uh, the matter went up to the Supreme Court, and the Supreme Court observed that a letter of credit is a contract between bank and beneficiary, not between buyer and seller. Strict compliance with letter of credit terms is mandatory. If documents do not exactly match, the bank can refuse payment. The bank is not concerned with trade customs or disputes between buyer and seller, it only checks the documents. So, payment under reserves cannot be stopped by courts, otherwise, the whole banking system would collapse. Only in clear cases of fraud, which is known to the bank, can the court interfere. Now, let's check your progress. The letter of credit open on the request of who request to open the letter of credit. It is the applicant, and the request is made to the issuing bank. So B is the correct answer for this question. The letter of credit issuing bank is also called the importers bank or the opening bank. So A is the correct answer. The advising bank's responsibility is to inform the issuing bank as to whom to issue the letter of credit, to advise the buyer the dispatch of documents by the seller, to inform the beneficial seller about the letter of credit. Yes, C is the responsibility of the advising bank. So C is the correct answer for this question. Now let's move on to our practice questions. Consider the following statements regarding letter of credit. A letter of credit is a negotiable instrument issued by a buyer to the seller. It is not a negotiable instrument, and hence this statement is not correct. Since statement 1 is not correct, we can easily eliminate option A, C and D, which left us with option B. So option B is the correct answer for this question. Which of the following statement regarding parties to a letter of credit are correct? The applicant is the exporter who receives the payment under the letter of credit. So the applicant is the importer, not the exporter. So this is not correct. Since statement 1 is not correct, option C can be easily eliminated. So now let's check for statement number 3. Since statement 2 is common in all these questions, statement 4 is common in all these questions, statement 3 is only in option D. So let's check for statement 3 first. The advising bank is responsible for confirming payment to the beneficiary in all cases. So the advising bank only advises the letter of credit, does not confirm the payment, and hence this statement is also not correct. So option D is not correct. we are not required to look into statement number 4 since it will be correct. Now let's see statement number 5. The confirming bank gives an additional guarantee to the beneficiary in case of doubts about issuing bank. So statement number 5 is correct. It is missing in option A, it is present in option B. So option B is the correct answer for this question. For these long statement based questions, elimination method works best. All right. So let's read statement number 1. Acceptance credit allows the seller to receive immediate payment only after submitting the documents. So acceptance bills allow deferred payment. They are users bills. Not immediate payment is required. So this statement is not correct, making option B and D incorrect. Now we are just required to see option number or statement number 2 to determine our answer. Irrevocable credit can be cancelled with the consent of issuing bank only. So irrevocable credit cannot be amended or cancelled without the consent of all the parties, right? So it states that it can be cancelled with the consent of issuing bank. So this statement is not correct. It requires the consent of all the parties. Without the consent of all the parties, irrevocable credit cannot be cancelled. So statement 2 is also not correct. So which left us with statement number uh, 3, 4, 5, 7, and 9. Let's read it. Um, Confirm credit involves an additional confirmation by the advising bank at the request of the issuing bank. So this statement is correct. Statement number 4, without recourse, credit protects the beneficiary even when there is discrepancy in documents. So without recourse does not protect the beneficiary. So there must be a typographical error with respect to options. So 3 is correct, 4 is not correct. Let's see for 5. Transferable credit allows the first beneficiary to transfer his right to another party if specifically mentioned in the letter of credit. So this is correct. Back-to-back credit involves only 2 banks. No, it involves 3. So this is not correct. Green clause credit allow pre-shipment advance and storage cost. This is correct. Revolving letter of credit allows multiple shipment without opening new letter of credit by renewing the amount after use. This is also correct. Red clause credit enables advance payment to the exporter before shipment. This is also correct. So statement number 3 is correct, 5 is correct, 7, 8, and 9 is correct. So in option A, the statement 2 should not be there, and option A would have been the correct answer for this question. Consider the following statements related to documents under a letter of credit. A bill of exchange can be drawn by any party involved in letter of credit transaction. It can be drawn only by the seller, not by any party. Hence, not correct. Hence, option A and B are not correct. An invoice must strictly follow details, including quantity and value as specified in letter of credit. Correct. So, statement 2 is correct. So it is open. Let's read another statement. A received for shipment bill of lading is always acceptable under letter of credit terms. It is not always acceptable unless explicitly allowed. So this statement is not correct. So C is also eliminated. Uh, let's read other statements as well. Otherwise, option D's are the correct answer. An airwell bill is not a document to the title of goods. This is correct. Post parcel receipts and courier receipts are acceptable if the letter of credit permits and usually indicate goods sent directly to the buyer. This statement is also correct. So option D is the correct answer for this question. Consider the following statement regarding UCPDC 600 and the obligations under letter of credit. It reduces the number of articles from 49 to 39. This is correct. So option C is not correct since 1 is correct. The term reasonable time was replaced with a fixed time of 5 banking days. This is also correct. So B gets eliminated. Does not recognize the presentation of electronic documents. It does recognize the presentation of electronic uh, documentation. So this statement is not correct since UCP recognizes the presentation of electronic documents. So option D is not correct, making option A as the correct answer for this question. Under UCP 600, a bank's obligation to pay a letter of credit is secondary and dependent on the uh, underlying contract. Not correct. Includes new article on definition and interpretation for clarity in application. This is correct. Now let's understand deferred payment guarantee. So, deferred payment guarantee is a bank promise to pay an exporter on behalf of an importer when the buyer has agreed to pay for goods in installment over time and not all at once. For example, a company in India imports expensive machines from another country. Now, the buyer cannot pay the full amount immediately and wants to pay in parts over 5 years. The exporter agrees but want assurance that they will get paid on time for every installment. Now, to protect the exporter, the gives buyer requests the bank to give a deferred payment guarantee. This means if the buyer fails to pay an installment, the bank will pay it to the exporter, so the exporter is safe and confident to ship the goods. Now, what is the purpose? The purpose is to purchase capital goods which are expensive. Buyer usually don't have enough cash or short-term credit to pay the full price upfront. And importing goods require foreign currency, which is limited and costly. Deferred payment lets the buyer to pay over several years, making the purchase affordable. But the exporter risks not getting paid if the buyer faces financial problems. So, the exporter risk is also minimized. It is rather eliminated because if the buyer does not pay, then the bank will pay. So, the deferred payment guarantee protects the exporter by assuring the payment. Now, payment method usually happens in three steps. There is an advance payment of 10 to 15% from the buyer's end. So, the buyer pays 10 to 15% of the total price before the goods are shipped to show the commitment. After shipment, the buyer pays another 10 to 15% once they receive necessary shipping documents through a letter of credit. And the remaining amount is paid in installment over say 1 to 7 years. Now this is where deferred payment guarantee comes in. The buyer's bank guarantees these payments to the exporters. Key features of deferred payment guarantee. So the exporter supplies the goods and the buyer agrees to pay later in installments. So there is postponement of the payment and there is a supply. Both buyer and seller agrees on when installment and interest must be paid. So there is a payment schedule. The bank gives unconditional and irrevocable guarantee to pay the exporter if the buyer fails to do so. This means the bank cannot refuse or cancel the payment once the guarantee is given. Now, similar to other types of guarantee, bank's liability in this case is also independent of dispute about goods quality. The bank's role is only to pay money on time. It does not check whether the goods are good or bad. Once the document for shipment are proper and match the letter of credit, the bank's promise stands. The schedule, the payment uh, of installment and interest is usually part of the main contract between the buyer and seller. And sometimes banks copy the schedule exactly into the guarantee document to be very clear. The exporter may issue usance bills for each installment amount, and these are bills payable on certain future date. The bank guarantees payment of these bills, and the exporter can even sell these bills to get the extra money. Now, the bank's promise is to pay is without any question or raising objections. So, the liability of the bank is independent and this guarantee is unconditional and irrevocable. This gives exporter full confidence to ship goods and trust that payment will be received on time. Now let's check your progress. Which of the following statement is false? In deferred payment guarantee, the guarantee is to ensure delivery of goods. No, this is not correct. A deferred payment guarantee is mostly based on a primary contract between buyer and seller. So this statement is correct. A deferred payment guarantee differs from other kind of guarantee as regard payment of liability of the bank on invocation. No, this does not differ. In a deferred payment guarantee, the bank's liability comes into existence only if all the installments are not paid and not on the non-payment of any one of the installments by the customer. So again, the statement is not correct. So C 1, 3, and 4 is the correct answer because these three statements are false. Which of the following statement is or are correct? Third party, mostly bank and financial institution, guarantees the payment of the installment. So this statement is correct. This guarantee ensures timely payment of the installment to the seller or export, failing which the guarantee can be invoked and payment received. Again, this statement is correct. To understand better the deferred payment guarantee, it is necessary to understand how a payment is made in a deferred payment contract and how the same is guaranteed by the bank. Again, correct. So, all of the above are correct, making option D as the correct answer for this question. Now, let's do some practice questions. Consider the following statements regarding a contract of guarantee under Indian Contract Act. A contract of guarantee must always be in writing to be valid. No, it can be oral or in writing. So this is not correct. The liability of surety is coextensive with that of principal debtor. Correct. A contract of guarantee involves three parties: debtor, surety, and creditor. Correct. Creditor must first exhaust all remedies against principal debtor before proceeding. This is not correct. In a bank guarantee, the bank guarantees the customer obligation to third party, usually for a commission. So yes, this is correct. So 2, 3, and 5 are correct, making option B as the correct answer for this question. Amit is the owner of a textile business and wants to purchase fabric from Ramesh traders on credit. Ramesh agrees to supply the fabric only if Amit provides a guarantor. Sunil, a friend of Amit, agrees to act as a guarantor. Based on this assurance, Ramesh delivers fabric worth 5 lakhs to Amit. Later, Amit fails to make the payment. Now, Ramesh approaches Sunil for payment, but Sunil refuses, saying that he did not receive any direct benefit or consideration. Meanwhile, Amit files for insolvency. Ramesh then files a suit against Sunil. Sunil argues that Ramesh must first recover the money from Amit and only then approaches him. So, in this particular case, Sunil will be liable. So, not liable, this question does not arise. So, A is not correct. Is liable only after Ramesh has exhausted all legal remedies. This is not correct. Liable to pay immediately since his liability is coextensive with that of Amit. This is correct. Is void as it is not in writing. This is not correct. So C is the correct answer for this question. Consider the following statement regarding continuing guarantee and its revocation. A continuing guarantee can be revoked for future transaction by giving notice to creditor. Yes, this is correct. Date of surety does not affect guarantee under any circumstance. This is not correct. Any change in the contract between the principal debtor and creditor without surety's consent discharge surety for future transaction. This is correct. Limitation period in case of continuing guarantee starts from the date of guarantee's execution. So it is starts from when the balance is constituted and not from the date of execution. So this is not correct. Banks often break running account of a borrower when they receive information of a guarantor's death. So this is also correct. So 1, 3, and 5 are correct, making option A as the correct answer for this question. Consider the following statements regarding the right and discharge of a surety in a contract of guarantee. A surety is discharged if the creditor releases the principal debtor without the consent of surety. Yes, this is correct. Mere forbearance to sue the principal debtor by the creditor results in discharge of surety. No, this is not correct. It does not result in discharge. A surety is entitled to the benefit of every security that the creditor has against the principal debtor. The time of the suretyship is made. This is correct. If the creditor loses a security that existed at the time of entering into contract, the surety is discharged to the extent of its value. This is also correct. The principal debtor is bound to indemnify the surety for all sums rightfully paid under the contract of guarantee. This is also correct. So 1, 3, 4, and 5 are correct, making option D as the correct answer for this question. Which of the following statement is or are true regarding co-sureties and guarantees? A guarantee obtained by the creditor through misrepresentation is valid only if debtor agrees. So this is not correct. Co-sureties are equally liable for the total debt unless there is a contract stating otherwise. So this statement is correct. The release of one co-surety discharge other from their liability. No, it does not. So only statement 2 is correct, making option B as the correct answer for this question. Which of the following statement about bank guarantees is or are correct? A bank guarantee is a contract where a bank guarantees payment to a third party on behalf of customer in case of default. So this statement is correct. A performance guarantee involves an irrevocable commitment by the bank to pay a third party if the customer fails to perform their contractual obligation. Yes, this is correct. Financial guarantees are typically used when a customer needs to deposit earnest money or a security for a contract. Again, this statement is correct. Performance guarantee ensures that the bank's customer will repay a financial obligation as per the agreed term. So, performance guarantee is non-financial obligation and not for the repayment of financial obligation. So, that's why this statement is not correct. When a customer defaults under performance guarantee, the bank is obligated to investigate the contract before making payment. No, this is not correct. Financial guarantee carries same credit risk as direct extension of credit to by the bank. Correct. In case of performance guarantee, the bank pays third party immediately upon receiving a notice of default without verifying the breach. So this is also correct. So 1, 2, 3, 6, and 7. 1, 2, 3, 6, and 7. Option A. Option A is the correct answer for this question. Which of the following statements are correct regarding the duty of a bank to honor guarantee? A bank is required to honor a bank guarantee irrespective of any dispute between beneficiary and debtor. Yes, this statement is correct. Bank can refuse if there is a dispute. No, so this is not correct. The bank's obligation to honor the guarantee is not affected by dispute unless there is a fraud or special equity. Yes, this is correct. A bank can refuse payment under guarantee if the main contract is suspended due to statutory provision. No, this is not correct. In case of fraud, a bank must be absolutely certain of fraud before refusing to pay under the guarantee. Yes, this is correct. If a company is being wound up, the bank is still obligated to honor the guarantee given on behalf. This is also correct. So 1, 3, 5, and 6 are correct. 1, 3, 5, and 6 are option C. So option C is the correct answer. Read the following statements related to the issuance of a bank guarantee and identify the correct combination of statements. The amount guaranteed must be clearly stated in both figures and words to avoid dispute. Correct. The period of guarantee is optional, does not need to be specified. So this is not correct. We don't want to make an unlimited liability. So that's why period of guarantee should be stated. The claim period is a period slightly longer than validity period to allow beneficiary to time to make a claim. This is correct. Section 28 allows a beneficiary to claim a bank guarantee at any time within 30 years. So the bank's liability cannot last 30 years. So the claims must be within limitation period. 30 years for government and 3 years for others. So this statement is actually incorrect. So 4 is incorrect. A counter guarantee cum indemnity ensures that the customer compensates the bank for any payment under the guarantee. The statement is correct. Banks are not liable for payment under guarantee once the validity period has expired, even if debtor defaults after the validity period. So the bank is liable for default within the validity period, but not after the claim, uh, not after it in the claim period. So the statement banks are not liable for payment once the validity period has expired. This is actually correct. Uh, Tangible securities like fixed deposits or immobile properties may be obtained to secure the counter guarantee. This is also correct. So, 1 is correct, 3 is correct, 5 is correct, 6 is correct, and 7 is correct. 1, 3, 5, there must be 6 as well. Okay. So, 6 should also be there. Here 6 is stated incorrect. Why? The bank is liable for default within validity period but not after it and the claim period. So this is actually correct, right? This is what is written here as well. Banks are not liable for payment under a guarantee once the validity period has expired. So that's why the period of guarantee is provided, and even if debtor defaults after the validity period, so bank will not be liable if the debtor defaults after the validity period, and that's why bank will not be liable. So that's why this is uh, correct. The bank is liable for default. Which of the following statements about deferred payment guarantee is or are incorrect? So DPG allows the importer to pay for capital goods in installment over a period of time. This is correct. Is provided by exporter to guarantee the payment of installments. It is provided by a bank and not the exporter. DPG helps the exporter by ensuring timely payment even if importer goes bankrupt. This is also correct. So 1 and 3 are correct, making option B as the correct answer for this question. Which of the following statements about deferred payment guarantee are correct? The buyer is required to make 10 to 15% advance payment at the time of contract. Yes, this is correct. A deferred payment guarantee includes a payment schedule for both installment and interest. Also correct. Bank guarantees the payment of installment only if goods are found to be defective. No, this is not correct. Banks are responsible for ensuring that goods shipped met the buyer's requirement. This is also not correct. The seller or exporter can discount the usance bill for the deferred installment with their bank. This is correct. So 1, 2 and 5 are correct, making option A as the correct answer for this question. So in this particular unit, we'll understand what are the different classes of bill, laws governing bill, we classify them, we'll understand various type of bill finance, the legal position of a banker, then we'll check your progress and do some practice questions. So what is bill finance? Bill finance is a method by which banks provide funds to customers by purchasing or discounting commercial bills that arise out of genuine trade transactions. And a commercial bill is created when goods are sold, but the buyer agrees to pay after a certain time. For example, if Mr. A sells the good to Mr. B today, but Mr. B agrees to pay the amount day after tomorrow or after 30 days. So it is a commercial bill. So instead of waiting for that time, the seller can take the bill to the bank and the bank will give the seller the amount immediately. Later on the due date, the bank collects the full amount from the buyer. Now, how does it works? So the seller sells goods to the buyer. Bill of exchange is drawn for the payment due. Bank purchases this bill from the seller and on maturity, bank collects payment from whom? The buyer. Now, why bill finance is considered easier and safer than other types of lending like cash credit or overdraft? Firstly, there is an underlying transaction to which is easy to verify. The bill is linked to an actual sale of goods. So, there is a transparency. Secondly, maturity date is fixed. There is a definite repayment date, so repayment schedule is clear. Extra signature is given for security. If it is usage bills, then it is payable after some time. It will usually have both the drawers and drawee signature, and bills are negotiable instruments. The bank can sell or rediscount them to another bank to get back their funds easily. Now let's understand the classes of bills and laws governing bills. So bills discounted or purchased by bank falls into three categories. Number one, clean bills. So these are bills without any supporting documents. Simply establishes that the drawee has to pay a certain amount on a certain date, and it is often used when goods have been delivered directly to the buyer. For example, a bill for 50,000 rupees for a local sale for local sale without transportation documents. Without documents. So it is an example of clean bill. Documentary bill. Documentary bills are accompanied by document of title to goods such as bill of lading, lorry receipt, or a railway receipt. So these are document to the title of goods. And number third, bills under credit. So bill drawn under credit, they are linked to conditions under letter of credit issued by bank. So they are linked to letter of credit. Now let's understand about laws governing bills. So what is a bill? It has been defined under section 5 of what? Negotiable Instrument Act of 1881. So what is a bill? A bill is uh, nothing but a bill of exchange. A bill of exchange is a written instrument which is signed by the drawer, and it contains an unconditional order directing a certain person, drawee, to pay a certain sum of money. It is payable to the drawer or to another person, uh, or to the bearer. So it is a written instrument containing unconditional order signed by maker directing a certain person. This certain person is drawee to pay a fixed sum to a specific person or a bearer. Bearer means whoever has this bill of exchange will get the payment. So there are three parties to a bill of exchange. Number one, drawer, the seller or the creditor issuing the bill, the drawee, the buyer or the debtor who agrees to pay, and the payee, the person who ultimately receives the payment. The person who is entitled to receive the payment is payee. With respect to relation, when we say relation, so drawer, who's the drawer? Keep that in mind that he is the creditor or the seller, and the drawee is the buyer or the debtor. Uh, okay, just give me a second. So yeah, now let's understand about other important provisions. So who is a holder? Holder is a person entitled to possess the bill and recover the amount in their own name. Example, bank after purchasing the bill. So bank becomes the holder if bank purchases the bill. Holder in due course. Holder in due course is a person who has obtained bill for consideration in good faith and has full rights to recover. Payment in due course, again payment made in accordance with the apparent tenure in good faith and without negligence to the rightful holder, and we have discussed this term payment in due course in detail in module A. I hope you remember. Negotiation. Negotiation is the transfer of bill to another person so that they can claim the amount. Yes, transfer of bill to another person so they can claim the amount. Then endorsement. Endorsement is signing the bill for transferring ownership. So it is signing the bill for what? For transferring the ownership. Then we have liabilities, liability of a drawer, of drawee, and of endorser. So with respect to liability of drawer, drawer must compensate the holder if the drawee fails to pay, provided due notice of dishonor is given. Then liability of drawee, acceptor or the drawee must pay the amount on maturity according to terms of acceptance. And then endorser, so endorser is liable to all subsequent holder in case of dishonor unless liability is excluded by contract. With respect to interest, so interest is charged at a specified rate, the rate which is stated, and if there's no rate stated, then interest is charged at 18% per annum. Classification of bill, so bill can be classified on the basis of place, on the basis of period, and on the basis of nature. So on basis of place, bills can be inland bills or foreign bills. So inland bills are bills which are drawn and payable in India or drawn in India on a person residing in India. So bill drawn in Delhi on a buyer in Mumbai is a inland bill. Foreign bill is a bill which is drawn outside India and payable outside India, or a bill which is drawn outside India but payable in India, or drawn in India on a foreign resident. So a bill which is drawn in London on a buyer in Chennai is a foreign bill. On the basis of period, we can classify bill into a demand bill and a usance bill. So demand bill is payable immediately on presentation. It is also known as side bill. Keep that in mind. It is also known as side bill. Why? Because it is payable immediately on presentation. And then we have usance bills. Usance bills are payable after a specified time for acceptance. For example, 60 days after the site. So the payment date is called maturity or due date. This payment date is also known as maturity or the due date. On the basis of nature, we have clean bill, documentary bills, and supply bills. So clean bills, we have understood it. These are not backed by any document of title. Then we have documentary bills backed by title documents. These are of two types: document against payment and document against acceptance. So in DP bills, document against payment, buyers get documents only after paying, and in documents against acceptance, buyer gets documents after accepting the bill and promising to pay on maturity. Then lastly, we have supply bills. So bills drawn for goods supplied to government departments are supply bills. Principles of Negotiable Instrument Act applies on them, though they are not fully covered. Now let's understand about types of bill finance. So number one, we have bill purchase. Bank buys demand bills. So bill purchase is mainly for demand bills. So these are usually for demand bills. So banks buy demand bills, whether clean or documentary, and pays the holder immediately. And after buying, bank becomes the holder in due course. Then we have bill discounting. It is generally for usance bills. Banks pays value minus the discount. So bank pays after minusing the discount and collects full amount at maturity. Then we have ABC, advance against bill for collection. Now loans given against bills are sent for collection. Customer get advance against all the bills which are sent for collection. And generally bank retains a margin for ABC. Bank keeps a margin and then pays the money. Bill finance and legal position of a banker. So banker has certain rights. When a bank purchases or discount a bill, bank becomes the holder in due course and can claim the amount from the drawing. We have two cases, Port Hursty Panchayat case, and then we have the State Bank of Mysore case. So in the first case, Port Hursty Panchayat case, bank discounted a check payable to sell for order. It was dishonored, but the court held that bank could recover because bank is holder in due course. And in the second case, customer argued that bank should sue drawers for unpaid bills, and in that case, court held customer was liable in respect of the bank. For discounting of documentary bills, we have Morvi Mercantile Bank case. Now, discount with respect to discounting of documentary bills, these are supported by title documents, and with respect to title documents, these title of documents are covered under Sale of Goods Act and Bill of Lading Act, and these documents can transfer ownership by endorsement or delivery. So in this Morbi mercantile case, bank held endorsed railway receipts for goods which are not delivered, and here the court held that bank was entitled to damages as owner. So documentary bills supported by document of title. Again, these two acts, Sale of Goods Act and Bill of Lading Act, relates to documents of title to goods. Lastly, we have DROI bill acceptance facility and bills co-acceptance facility. So in DROI bill acceptance facility, banks pays the drawer on presentation and collects from DROI later. It is used as an alternative to cash credit. And in bills co-acceptance facility, banks accept bills jointly with borrower, sharing liability and recover from the borrower. Now let's check your progress. Bill of exchange means an unconditional direction to the drawer to pay the money, promise to the drawer to pay the money, obligation to the drawer to pay the money, or undertaking to the drawer to pay the money. It is an unconditional order and unconditional direction to the drawer to pay the money. It is actually an unconditional direction or order to the drawer to pay the money, not the drawer. So here it is some typographical error, right? So it is the drawer who pays, not the drawer. Drawer actually gives the unconditional order, actually gives the unconditional direction. The maker of the bill is called, he is the drawer who makes the bill, and this drawer directs the drawer to pay. Alright. Bill purchase facility is granted in case of bill purchase facility is particularly given, it is usually given in the case of demand bills. So A is the correct answer. Here C is the correct answer. Ownership of goods can be transferred by endorsement and delivery of, it can be transferred by the delivery of document of title to goods. So C is the correct answer for this question. Now let's do some practice questions. Consider the following statement relating to bill finance and bill of exchange. Bill finance involves discounting or purchase of commercial bills arising out of sale of goods. This is correct. One advantage of bill finance is the absence of a definite repayment date. It is actually the presence and not the absence. So this is not correct. A bill of exchange carries only one party signature. No, it carries both party signature and it is transferable. Hence, this is not correct. As per section 5, a bill of exchange contains unconditional order to pay money. Yes, this is correct. In a bill of exchange, the drawer is the creditor or seller and the drawer is the debtor or buyer. Yes, this is also correct. So 1 is correct, 4 is correct and 5 is correct. So option B, 1, 4 and 5 is the correct answer for this question. Identify which of the following statements are correct as per the Negotiable Instrument Act related to bills. The person who signs a bill to transfer it is said to have endorsed it. This is correct as per section 15. A holder in due course is entitled to receive the amount without consideration. No, it is because of this consideration that he is eligible, he is entitled to receive the amount. Hence, this statement is not correct. The drawer is liable to compensate the holder if the bill is dishonored, provided due notice is given. This is correct. If no interest mention is specified in the bill, it is payable at 18% per annum. Absolutely correct. Negotiation of a bill requires transfer without consideration. Negotiation must be with consideration and not without consideration. Hence, this is not correct. The acceptor is bound to pay the bill amount at maturity according to apparent tenure. Yes, this is correct. So 1 is correct, 3 is correct, 4 is correct, and 6 is correct. So 1, 3, 4, and 6. Option A is the correct answer for this question. Which of the following statements about bill of exchange is or are correct? An inland bill can be drawn in India and made payable in a foreign country. So this is correct. Inland bills can be made payable outside India as long as the drawee is a resident of India. That's why this statement is correct. Foreign bills are always drawn outside India and made payable in India. No, they can be drawn outside India or they can drawn outside India, payable outside India. So not mandatory made payable in India. So that's why this statement is not correct because it's always. A demand bill must specify a time for payment. No, this is not correct. A demand bill is payable immediately, right? They are side bills. So that's why this statement is not correct. A usance bill is payable on demand after acceptance. The usance bill specifies a time for payment after acceptance. They are not payable on demand, they are payable on time after acceptance. A documentary bill requires payment or acceptance before document of title are uh, delivered. So yeah, documentary bills require either payment or acceptance or DP bills or DA bills before the documents are delivered. So this statement is correct. So statement 1 is correct and statement 5 is correct. Here we have 135, 145, 14 and 24. So actually 1 and 5 are correct. 4 is not correct because it is payable on time and not demand after acceptance. So let's see. It states, yeah, it states time after. There must be a typographical error. So if it is time, then it will be correct, and then it will be uh, option D 145. It specifies time and not demand. That's why 145 will be correct. Read the following statements related to various types of bill finance and identify the correct combination of true and false statements. Bill purchase involves immediate payment of the face value of the bill to the holder by bank. So yes, bill purchase involves immediate payment because they are usually related to demand bills. Bill discounting is only applicable to demand bills. No, bill discounting is related to usance bills and not demand bills. So the statement is not correct. Under ABC, the bank requires a margin to be kept by the customer. Yes. Bill purchase is applicable for both clean and documentary bills. So this statement is also correct. The bank requires a margin. So under statement 3, under ABC, the bank requires a margin. So bank keeps a margin, not the customer. So that's why this will not be correct because bank keeps the margin, right? And it is not the customer who keeps the margin. So that's why this statement will not be correct. 4 will be correct. In bill discounting, the bank pays the full face value. No, they don't pay full face value. They pay a value after deducting the discount. So that's why this statement is not correct. Bill purchase can be used for bills whether the due date is not immediately known, such as usance bills. So bill purchase can be used for usance bills where the due date is not immediately known. So this statement is correct. So 1 is correct. 4 is correct, 6 is correct, 1, 4 and 6. So option A is the correct answer for this question. Read the following statements and identify the correct ones. In bill discounting, the banker becomes the holder in due course and is entitled to receive the amount from the acceptor. So this statement is correct. In the case of dishonored bill, the banker cannot recover the amount from the drawee as the drawee is not liable for the banker. No, this statement is not correct. Banker can recover the amount. The case of Port Hersey Panchayat held that the bank cannot recover the amount from a panchayat if the check is dishonored. No, actually the bank can recover because bank is holder in due course, and that's why this statement is not correct. Sale of Goods Act allows a bank to transfer ownership of goods by endorsing and delivering Document of title to goods. So this statement is correct. A documentary bill is supported by documents such as bill of lading, warehouse, receipt or railway receipt, which can transfer ownership of goods to the bank. This is correct. In the case of Morvi Mercantile Bank versus Union of India, the court ruled that the bank was entitled to receive the value of goods based on the endorsed railway receipt. So again, this statement is correct. DROI bills acceptance facility allows a bank to accept bills on behalf of borrower and sue the DROI for the amount on the due date for the amount due on the bill. Sorry, yes. So this statement is also correct. So one is correct, four is correct, five, six, and seven is correct. One, uh, one is correct, four is correct, five and six and seven. So six should also be there. So one, four, five, six, and seven are correct. So D will be the correct answer for this question. And in this particular unit, we'll discuss about credit cards, home loan, other personal loans, and consumer loans. We'll wind up this session by doing some practice questions. So let's begin. Credit card. What is a credit card? Credit card is a type of short-term loan that allows you to buy goods or services without paying cash immediately. The bank or financial institutions issue credit cards to customers they approve. You can pay the full amount on the due date without any interest. Alternatively, you can pay part of the bill more than the minimum amount due and carry the remaining balance forward. Now, this will attract financial charges or the interest. There are mainly five parties involved in credit card system. So there are card holders, people authorized to use credit cards to pay for goods or services, credit card issuers. So suppose your bank issues a credit card to you. Now you uses this credit card, so you are the card holder. Then the bank is the card issuer. When there are merchants, you go to a shop, you buy certain goods or you avail services. So the shop or business that accepts credit card as payment are merchants. When there are merchant acquirers, so bank or NBFCs that process credit card payment for the merchant are merchant acquirers. And last but not the least, there are credit card associations. So organizations like Visa, MasterCard, RuPay, which provide licensing rules and settlement services for card issuers and merchant acquirers. Now, credit card benefits to three parties: cardholders, merchants, and banks. With respect to cardholders, say now you are the cardholder, so you can immediately purchase do a purchase without carrying cash. So they are convenient cashless purchases. You enjoy a interest-free credit period, which generally ranges from 15 to 51 days. You can additionally withdraw cash from ATMs, but again, there are certain financial charges which are attracted when you do cash withdrawals using credit cards. But nevertheless, you have this facility that you can withdraw cash from the ATM. Once you purchase something using credit card, it also serves as a proof of purchase that you have purchased something via banking channel in case any dispute arises. And you can also add your family members to the card. And to merchants, now they don't have to extend credit facility to to their customers, so it reduces the need to extend credit facility. It increases their sale due to customers high purchasing power. Merchants at preferred locations, which allows credit card usage, they attract customers. Sales are recorded systematically through banking channels. Now there is a promotional support from the card issuer as well. It builds the customer base. Payment is assured. Payments are quick, and it avoids large cash handling for the merchant. And with respect to banks earn a certain percentage of profit from merchant transactions via fees and card usage. It builds relationship with new customers. It offers additional facilities to the existing clientele. So it in a way it attracts new customer and it retains the existing ones. It offers a wide network of cardholders, which increases bank reputation, bank popularity, and it saves on cash handling, stationery, and workforce cost. But again, there are certain disadvantages, and these are mainly to the cardholders. So, a credit card may encourage overspending, risk of fraud is always there, and there's a possibility of debt trap. So, for example, there's a person A, he has a credit card with a limit of say 1 lakh rupees, and his income is 50,000. Now, what he does, he purchased something, some goods worth rupees 1 lakh rupees via credit card. Now, his income is only 50,000. Now, what A does, he thinks like, I can only pay the minimum amount due, and let's carry forward the outstanding amount. So, this minimum amount due, payment of only minimum amount due is actually uh, is madness. So, when he carry forwards the outstanding amount, bank charges certain percentage, and this certain percentage, my friend, is not less percentage. This can vary from anywhere between 36% to 55% per annum. So now Mr. A has to pay this high interest rate and will always be trapped in this debt. So this disadvantage of debt trap, the possibility of debt trap is always there. Now there are certain guidelines which are issued by RBI for credit card operations. So the Reserve Bank of India regulates how banks and NBFCs issue and manages credit cards. So only banks with net worth of greater than 100 crores can issue cards themselves or through subsidiaries or partnerships. NBFCs must get RBI approvals to issue credit cards, and card issuers must have a board approved credit card policy displayed on their website. There are certain prohibited practices like this should not be any unsolicited cards or automatic upgrades without the consent, and the charges for such card, if a bank charge something for these cards, have to be reversed, and a penalty must be paid. Sanction of credit cards. So decision to issue a credit card lies with card issuer. So who's the card issuer? The bank and the NBFC, and not the agent. So banks must carefully assess the credit risk, especially for student or people with no independent income. They should consider all the credit cards held by a person before setting a limit. KYC compliance is the responsibility of the card issuer and not the agent, not the person who approaches you. Sir, get a card of XYZ bank and you get certain benefits. Now, that person, that agent, the third party, or the outsourced uh, person who is just there to on behalf of bank to call people and tell about the credit cards is not responsible for the KYC. Who is responsible? The bank is responsible. The terms and conditions must be simple, multilingual, and they should be available in the local languages. The terms and conditions should include a key fact statement that there should be one page summary of interest rate, charges, and other terms provided with the application. Reason for rejection must also be communicated in writing. Most important terms and conditions should be shared at all stages, be it marketing, be it at application stage, card issuance stage, and for every subsequent communication, most important terms and conditions should be shared. Card transactions converted to EMIs must clearly show the principal, the interest, and any discount which is offered. No zero interest EMI should be misleading claim. Loan offered via credit card must also follow RBI loan instruction. Insurance offers, so optional insurance can cover lost cards or frauds. Explicit consent again must be obtained from the cardholder, and cardholder should have insurance company contact details for the claim. There are three types of credit cards which we need to understand. There's co-branded card, corporate card, and add-on cards. Co-branded cards are issued by non-banking companies, and bank must check the company's credibility. For example, Amazon ICICI card. So it is a co-branded card. SBI Indian Oil card. HPCL ICICI Bank card, Flipkart Access card. So there are examples of co-branded cards. They're issued by non-bank company, the retail brand, the petroleum company. Uh, so that's why banks must check the company's credibility. Then there are corporate cards. Now these cards account in corporate name and it is used by employees. Roles and liabilities of both the parties must be clear. There are add-on cards. It is issued to family members of the primary card holder. The liability of repayment resting on the primary holder. Issuance of cards. So when a customer applies for a credit card, the bank or NBFC must clearly explain the fees, the interest rate, other charges, how bills are generated, how payments are made, how overdues are calculated. So everything must be communicated to the customer, and customer should be informed about the expected time of the card issuance. So banks must inform the customer about the target time. A card may be issued in a deactivated mode. So activation happens only after the customer accepts the card and completes the activation steps. Customer can request a lower credit card or supplementary or an add-on credit card, which is compared to the main card. All new cards and replaced cards are EMV. They should be enabled with the EMV chips and PIN enabled, making them more secure against the fraud. Euro, Mastercard, Visa chips, EMV. If the bank reduces the credit limit, the bank should inform the customer why this decision has been taken, and bank must process cancellation request promptly. Confirmation must be sent within 7 working days after the request once all dues are cleared. Credit card statements. So monthly statements are there. Bank provide monthly statement free of cost. Statement shows all purchases, cash withdrawals, payments, and it is available on internet banking. If there is any reporting default, if there is any reporting default, bank follow a board approved procedure before reporting a default to CIC. Credit information companies, and customer gets sufficient notice before any reporting. Interest rate and other charges. So credit card dues are considered personal loans and not priority sector loans. Interest should be reasonable, reflecting the bank cost and expected return. These credit cards are unsecured loans, and that's why interest rate is high. So bank must also set a ceiling for interest rate and other fees. There should be transparency. uh, no hidden charges. Even if the card is free of charge, no hidden charges should be there. If interest rates vary based on payment or default history, this must be clearly explained. Banks must explain how finance charges are calculated. It includes examples for situations where only part of outstanding is paid. Bills should be sent on time. Customer must have at least 15 days to make payment before interest is charged. APRs, annualized percentage rates, must be quoted separately for retail purchases and cash advances if different. It includes examples to show how APR is applied. Minimum payment warning should be given. Even if only the minimum amount is paid, interest is charged on the remaining balance. And monthly statement must show a warning that if you pay minimum amount, it would result in repayment stretching over years, and there's a high interest on the outstanding amount. Again, banks and NBFCs cannot charge fees which is not disclosed at the time of issuing the card. So there's no unauthorized uh, charges. If there is any change in fee or the term, the customer must be informed at least 30 days prior. So you give at least 1 month prior notice to the customer if there is any changes. With respect to wrongful billing, banks and NBFCs that issue credit cards must ensure that the incorrect billings are not sent to the customer. If the customer notices a wrong billing and raises a complaint, the bank must respond within 30 days. The response should include a clear explanation and documentary proof showing why the bill is correct and how the error has occurred. With respect to redressal of grievances, customers are generally given 60 days to raise complaints regarding billing, fraud, and service issues. So, bank or NBFCs must have a dedicated grievance redressal mechanism, which should be widely advertised through print or electronic media. So, the name and the contact details of the designated officer must be mentioned on the credit card statement. If a complaint is not satisfactorily resolved within 30 days, the customer can approach the banking ombudsman. I hope you remember we have a dedicated unit on banking ombudsman, which we have covered in module A. So I hope you remember it. The bank or the NBFC may be liable to compensate the customer for any loss of time, for financial loss, for expenses incurred, or for any harassment or mental stress. Then there is complaint escalation process. So the bank or NBFCs must have a system to automatically escalate unresolved complaints. And if there is any fraud in card not present transaction, if a fraudulent or online transaction occurs and the bank has not implemented two-factor authentication, so 2FA, two-factor authentication, so the bank must reimburse the customer fully without any delay or the dispute. Fraud control. So bank and NBFCs are responsible for reducing fraud and misuse of lost or stolen cards. So RBI has mandated several mechanisms to secure card features, to blocking cards. So cards may have cardholders photograph, pin, laminated signatures, and currently ENV chips card with pin are mandatory. For block cards, banks must block a lost card immediately once informed by the customer. Other formalities such as FII can follow later. SMS or email alerts are sent every time a transaction occurs, keeping the customer informed in real time. Two-factor authentication are required for CNP transactions. All online or card not present transaction must use two-factor authentication as mandated by RBI. And banks may offer insurance cover to protect customers against losses due to lost or stolen card. Tokenization is there. So what is tokenization? Tokenization is a process that replaces actual card details with a unique token, making transaction safer. So this token is unique for the card, device, and token requester. During a transaction, the merchant never gets the actual card details. Tokenization can be done via apps and devices like mobile phones, tablets, laptops, wearables, or IoT devices. For example, if you tokenize your credit card on your mobile wallet, the app generates a unique token. And when you pay online, the merchant only sees the token and not your real card number. Even if the token is stolen, your actual card details remain safe. And now there are various stakeholders involved in tokenized transaction. So it is you, the customer, the merchant, merchant acquirer, token service provider, token requester, and the issuing bank. Other entities may also participate depending on their transaction flow. Now let's move on to home loans. Home loans are one of the most common type of loan we all know given to individuals by bank. In life, people often need funds for major expenses, be it health insurance, marriage, education, buying a house, purchasing vehicles, and in earlier times, people borrow money from their friends, money lenders, which charges unreasonable interest rate. So banks enter the picture to provide loans at reasonable interest rate and on fair terms. So banks issues these personal or retail loans like home loan, which is most important component, vehicle loan, consumer loan, personal loan, gold loan, education loan, which we have already discussed in our uh, earlier units. So home loan are often competitively depending on the factors like age of the borrower, income profile, repayment capacity, past repayment history, property location, verification report. So there are various factors. Now let's talk about the procedure and practices for home loans. So who is the target group? Salaried individuals, professionals, self-employed people, businessmen. So they are offered to both resident and NRIs. So home loans are offered to both resident and NRIs. What is the purpose of a home loan? The purpose can be buying a housing plot, constructing a house, repairing or renovation, or buying house sites in case some banks allow it. Quantum of the loan, it is based on the income and the cost of house, cost of the property. So bank usually ask for proof like salary certificate, ITR, bank statements to determine the quantum of the loan. There is a age criteria. Bank can set minimum maximum age limit of the borrowers. So they consider the remaining years of service, income earning capacity, and the maximum age for repayment is retirement age or 70 years, whichever is earlier. Repayment is usually through EMIs, and repayment period can extend up to 30 years. But again, it should not exceed the age limit. EMI schedules are often customized based on expected income trends during the loan period. There are credit track records, so borrowers' credit history and credit scores are checked through CICs. A good past repayment record helps in getting better interest rate and terms. With respect to security, the house for which the loan is taken is acts as security. Property purchased or constructed with the loan is mortgaged with the bank. If a spouse income is considered, they are included as co-borrowers or guarantors, and if the property is jointly owned, the other owner is also included as co-borrower. Interest can be fixed or floating, and longer the term, higher the interest rate will be charged, but lower will be the EMI. Customer sustainability and transparency. Bank must ensure that the product is suitable for the customer, and borrowers should be fully aware of all the risks and liabilities before taking the loan. Housing loans can be taken again for various purposes like acquisition of land. So banks can provide loans to buy a plot of land provided the borrower declares that they will construct a house on that plot within a period specified by the bank. Construction or ready built house or repairs. So how home loans can be provided to individuals for buying or constructing a house. It includes repair for damaged houses, for buying or constructing a second house. If the borrower is posted elsewhere or is provided accommodation by their employer for rental purposes, they can avail the home loan. It helps tenants purchase the house they currently live in, and it also helps in slum improvement schemes. So direct credit to slum dwellers with government guarantees. Um Indirect credit is also provided by state government or public agencies, and loan may also be extended to slum clearance board for housing improvements. But again, there are certain conditions for legal compliance. So there are generally guidelines which were issued by the Delhi High Court. So borrower must provide a copy approved by the authority. Borrower promises to follow the sanction plan and obtain a completion certificate within 3 months of construction. A bank appointed architect must certify the construction at the stages and confirm the completion certificate. Affidavit confirming house built according to sanction plan and building bylaws. Loans are not given unless the colony is regularized and development charges are paid. And loans cannot be given for properties which are meant for commercial purposes. Supplementary finance can be provided. Supplementary finance is the additional finance for alteration, addition or repairs. So banks can provide alternate additional finance. Prohibited purposes. So banks cannot finance buildings which are meant purely for government offices, except if they are refinanced by NABARD. Public sector projects not run on commercial lines or not corporate entities, and projects where bank finance is used as a substitute for government budgetary resources. So they are prohibited. Lending to housing intermediate agencies. So these are the loans provided to agencies that help individuals or communities with housing. So financing land acquisition for projects, a bank can lend to public agencies. Keep that in mind, not to private builders, for buying land and developing infrastructure like water, roads, drainage, and projects should be completed within 3 years. Project should be completed in 3 years. Loans to individual beneficiaries with these projects follow the same term as direct loan, and valuations are done by professional independent valuers based on market prices plus development cost. When there is lending to housing finance institutions, a bank can provide term loans to housing finance institutions considering their debt equity ratio, track record, and recovery performance. These provisions are applicable to non banking finance companies. Uh, so NBFC guidelines also applies. Term loans can be given to state level housing boards or public agencies, and bank check their uh, past recovery performance and ensure timely completion from beneficiaries. Then there are term loans to private builders. Private builders may get loans on project specific commercial terms. Bank cannot finance land acquisition by private builders. Only builders with professional staff and good reputations are concerned, and bank monitors fund to ensure no land speculation is there. And prices charged to beneficiary must reflect actual cost plus reasonable profit. No speculative element should be there. Uh, term, terms and conditions. So term loan may be granted regardless of the borrower size. Loans to NRIs requires RBI authorization. Interest rate must follow RBI guidelines. And loans to housing intermediary agencies must comply with RBI norms for commercial real estate exposures. Loan to value ratio. So LTV ratio is the percentage of property value which the bank is willing to finance. Higher the property value, stricter the LTV ratio. So for up to 30 lakhs, LTV ratio uh, should not be more than 80%. Uh, where the risk weight is 35, where the risk weight and where the LTV is greater than 80 and less than 90, the risk weight is 50%. For 30 lakhs to 75 lakhs, it should be less than 80%. For above 70 lakhs, the LTV ratio should be less than 75%. Sorry. Now, residential housing for commercial real estate, CRE loans, the risk weight is 75%. There are new risk weights from applicable from October 16, 2020. So LTV, where the LTV is less than 80% or equals to 80%, the risk weight is 35%. Um, and where the LTV is greater than 80% and less than or equals to 90%, the risk weight is 30%. So while calculating LTV, stamp duty, registration, documentation charges, they are generally excluded. For affordable housing for EWS and LIG housing, low income group or economically weaker section, where the house costs less than 10 lakh rupees, banks may include these charges for calculating the LTV. There are several documents required. Number one, sale agreement or sale deed. This is property related documents. No income branch certificate shows property is free from legal dues, which is usually for 13 years. Title search, which is proof of ownership, which is required for 30 years. Approved building plan, NOC from housing board, and valuation report from bank approved engineers. So these are property related documents. Then you required income related documents, and then this identity document. So income related document includes bank statement for last 12 months, a salary certificate, income tax return for last 3 years, and then identity related documents like KYC documents. Banks consider the engineer's valuation report and advocate's opinion, and processing fees is usually 1% of the loan amount. After sanction, bank collects DPN, deposit demand promissory note, home loan agreement, and guarantee agreement. Insurance should be there, so property insurance is a must, which secures the property against fire, earthquake, or flood. And some banks also insist on borrower's life insurance. Now, EMI payments. For EMI collection, banks often use NACH authorization for auto debit of EMIs. It prevents missed payment and serves security. If NACH fails due to insufficient balance, bank can take legal action under Section 25 of Payment and Settlement System Act. Disbursals of housing loans. So banks ensure borrowers have obtained government or statutory approvals before disbursing the funds. Where there's a stage-wise disbursals for completed houses, disbursals should be done in lump sum. For under construction properties, payment is linked to construction stages and should not be given upfront. Bank avoids upfront disbursement for incomplete projects due to reduce the risk. There are certain innovative schemes like 80-20, 75-25. So some bank disburse full loan upfront to developers while the borrowers pay EMI service to the builders during construction. There are various risks involved in these types of schemes like disputes between borrower and builder, if there is any delay in trust, if the project is not completed on time, or it might adversely impact the borrower's credit score. So RBI recommends stage-wide disbursals linked to construction progress. Then there are some government or sponsored projects. So bank may follow payment stages prescribed by the government authorities for such project. RBI has clearly instructed that there should be no foreclosure charges or there should be no prepayment penalty on floating rate home loans, personal loans. So unlike secured loans, personal loans are often provided without any tangible security based on the borrower's personal credit worthiness, like salary loans, loans to professionals. So these are generally offered to salaried class because their income is regular and predictable. Now, who is the target group here? Permanent employees with a minimum service period, say minimum service period of 3 years. Eligible employee may work in government or quasi government organization, boards, endowments, or reputed private companies. Purpose can be anything personal like meeting marriage related expenses, medical expenses, family functions, and the eligibility amount is calculated uh, based on the income level, minimum take home salary, and bank may allow higher loan if the employer agrees to deduct EMI from the salary directly. A borrower maintains salary account with the bank. Usually, personal security are the third party guarantees. There are certain documents which are required to avail these kind of loan, like proof of employment, salary certificate, and after sanction, bank may ask for demand promissory note, guarantee agreement. uh, there is the interest rate charged is higher from the secured loan because absence of collateral is there. There is no cushion. Electronic clearing service debit mandates are often taken to ensure timely EMIs. Repayment period varies from anything between 3 years to 5 years, and processing fees are charged as a percentage of loan amount. So usually charge a percentage of loan amount as processing fees. Then there are consumer loans. Consumer loans, the purpose is to purchase consumer durables and white goods like TV, AC, personal computer, laptops. Eligibility amount is based on the cost of item and borrowers. Margin contribution is typically 10 to 20%. Repayment period is 3 to 5 years, and the charge created on consumer loans is that of hypothecation. So documents required are salary certificate, IT returns, quotation from dealers, bank statement, debit mandates for EMI collection, and post sanction. Yes, hypothecation agreement is asked because the goods are hypothecated. Now let's check your progress. One of the following statement is not true with respect to credit cards. The card issuing bank would not be responsible for fulfillment of KYC where agents solicit business. So this statement itself is not true. The card issuing banks, they would be responsible for fulfillment. So this not makes it incorrect. So A is the correct answer for this question. If the guidelines of RBI in the matter of credit card are violated, it can levy penalty on the violating bank under Banking Regulation Act. So D is the correct answer. When bank gives home loans, for home loans the nature charges mortgage. So B is the correct answer for this question. Now let's do some practice questions. Which of the following statement about MSMEs uh, in India are correct? So these questions belongs to a different unit and not to this unit. So okay, now let's do practice questions. Which of the following statements about credit card is or are correct? Cardholders are authorized to use credit card for payment of goods and services. So this statement is correct. So option B is eliminated. Credit card issuers are institutions that process credit card transaction for merchants. Credit card issuers are banks and NBFCs. They do not process transactions for the merchants. There are merchant acquirers who does that, not credit card issuers. So 2 is not the correct statement. Hence, option C is also eliminated. 3 is common in both, 5 is common in both. Let's read either statement 4 or statement number 6. Let's read statement 4. Credit card offer interest-free period ranging from 30 to 90. It is 15 to 51, not 90. So, the statement number 4 is not correct, making option D as the correct answer. for this question. Consider the following statement regarding RBI's master directions. Schedule commercial banks including RRBs. So it is excluding RRBs and not including RRBs. Uh, that's why statement 1 is not correct. So A and B gets eliminated. 2, 3, 4 and 6 are common. Only statement number 7 differs. So let's read statement number 7. Credit information relating to new credit card accounts can be reported to CICs even before card activation. No, this is not correct. So 7 is not correct, and hence 2, 3, 4, 6. Option number D is the correct answer for this question. Consider the following statements regarding credit card issuance and usage guidelines. So banks must issue credit card statements free of cost every month to the cardholder. Yes, so this is correct. Option D gets eliminated. So it is either A, B, or C. So let's read statement number 2. A credit card holder should receive at least one fortnight for payment before interest is charged. So this statement is again correct. So 2 is correct. Hence C is eliminated. So let's read statement number 3 and we'll get our answer. Banks can charge interest rate on credit cards without disclosing APR. So they should disclose APR and they cannot charge without disclosing it to the customer. And hence, this is not correct, and which eliminates option B and remains remaining option A is the correct answer for this question. Identify which of the following statements regarding credit card grievance redressal and fraud control are correct. A time limit of 60 days is generally given to the customer to lodge complaint. This is correct. So it was there in every option, you see. So even if we have skipped reading statement number 1 or statement number 2 as well, will not get any harm. So we can skip reading statement number 2 because it is there in every option. In case of fraudulent CNP transaction without two-factor authentication, the customer bears the loss. No, it is the bank who bears the loss and not the customer. So statement number 3 is not correct. So C and D gets eliminated. 4 and 5 is there in both A and B. So let's read statement number 6. SMS or email alerts are sent to customers for every credit card transaction. It is correct. So B is the correct answer for this question. Which of the following statements regarding are related to retail home loans are correct? Banks may allow maximum home loan tenure of up to 30 years, subject to retirement age of 70 or subject to retirement age or 70 years of borrower, whichever is earlier. So this is correct. A gets eliminated. So 2, 4, 5, 7, 3, 5, 6, 2, 4, 7. Let's read statement number 2. Home loans can be sanctioned even for the purchase of house sites depending on bank's internal policy. This is correct. So 2 is correct. 4 is common. Let's read statement number 5. A borrower credit report from CIC is a key factor in determining loan eligibility and interest term. It is indeed a key factor, and that's why option number C is the correct answer for this question. Which of the following statement about housing loans is or are correct? Bank can finance the construction of houses in unauthorized colonies provided the colony is regularized and development charges have been paid. So if they have been regularized and development charges have been paid, then bank can finance. So this is correct. So 1 is correct. Let's read statement number 2. A borrower applying for a home loan for purchasing a ready-built house must provide an affidavit that the property has been constructed according to the sanction plan and building bylaws. This is correct. Home loans can be granted for construction of buildings meant purely for government and semi-government offices. This is not correct. So 1 and 2 are correct, making option B as the correct answer for this question. Which of the following statements regarding the quantum of housing loans and their associated risk weight is correct? For housing loans up to 30 lakhs with a LTV ratio of less than 80%, the risk weight is 35%. This is correct. So B gets eliminated and D gets eliminated. It is either A or C. All the statement differs in it. So 1 is correct. Let's read statement number 2. For housing loans above 75 lakh rupees with a LTV ratio of less than 75, the risk weight is 35. It is actually 50% and not 35%, and hence 2 is incorrect, making option A as the correct answer for this question. Which of the following statements are accurate regarding the documents and processes involved in a home loan application? A no encumbrance certificate is required for a period of 5 years during the loan application process. So it is 13 years, not 5 years. So hence the statement is not correct. One gets eliminated and A and D gets eliminated. 2 and 4 is common. Let's read statement number 5. NSH authorization is not required. It is actually required. So 5 is not correct, and hence option number C is the correct answer for this question. Which of the following statements are correct regarding salary loans? Salary loans are primarily offered to employees with stable income from government or reputed private organizations. So this statement is correct. The repayment period for salary loans typically ranges from 3 to 5 years, 36 to 60 months. So this is also correct. Bank may accept third party guarantee in absence of collateral security. This is also correct. So all three statements here are correct. Which of the following statement regarding consumer loan is or are correct? Consumer loans are primarily aimed at purchasing consumer durables and white goods. So this is correct. So one is correct. B gets eliminated. The minimum take home pay after proposed EMI should be ensured before sanctioning the loan. This is correct. So 2 is also correct. So C gets eliminated. The loan is determined solely based on the cost of article being purchased. So the loan amount is determined both by the cost of article and the margin brought by the borrower. So it is not solely based on the cost of article, and hence C is not the correct statement. D is get eliminated. Um, so A is the correct answer for this question. So in this particular video, we'll understand about the targets and sub targets for priority sector. What are the categories of priority sector advances? What happens if banks fails to achieve their priority sector targets? What are the common guidelines? And what are the other modes of lending to priority sectors? We'll do our practice questions and we'll wind up this class. So the concept of priority sector lending was introduced in 1972 based on the recommendation of a study group formed by the RBI in 1971. The aim was to ensure that credit flows to sectors of the economy that are important for inclusive growth. Hence the name priority sectors. They are important for the economy but may not always be attractive to commercial banks, such as agriculture. Agriculture is not attractive to commercial banks. They will not fetch our rate of interest from agriculturists. Weaker sections. So by 1980, RBI directed all commercial banks to achieve 40% PSL target, priority sector lending target of their total advances by 1985. So 1980 RBI set this target and it has to be achieved in next 5 years, that is 1985. Over time RBI has revised these norms and will understand each of them in this particular unit. With respect to applicability, the priority sector targets and sub targets are mandatory for all commercial banks. This includes public sector banks, private sector banks, foreign banks, RRBs, small finance banks, local area banks, and also these targets apply to primary urban cooperative banks. And recently, the targets for small finance banks and primary urban cooperative banks have been changed. We will also discuss in it, today's class, and it excludes salary earners banks. So these targets are not applicable to salary earners banks, so they are excluded. So what are the targets? For domestic commercial banks, the target is 40% of ANBC or CEOBE. So we'll understand how do we calculate this ANBC, which is adjusted net bank credit, and CEOBE, which is credit equivalent of balance sheet exposures. So we'll understand how do we calculate them. For foreign branches with less than 20, foreign banks with less than 20 branches, again 40% is a target. But here they can give 32% to export credit. which is a category of priority sector advance. For RRBs, again, the target is 75%, and for small finance bank, the target is 75%. But recently, for small finance banks and urban cooperative banks, this target has been reduced from 75% to 60%, but it will be applicable from 1st April 2026. So it has not been made applicable yet, but the target will be reduced. With respect to domestic commercial banks, the agriculture targets are 18%, of which 10% of should be for small and marginal farmers. And this applies to foreign banks as well, with 20 and more branches. This is not the case with the agriculture targets are not there for foreign banks with less than 20 branches, because they can divert 32% into export credit, and the rest 8% they can lend to any other priority sector. For RRBs, again, this is 18%. For small finance banks, again, this is 18%. Then we have micro enterprise. So this is agriculture. This is all there in the next slide. Don't worry. But I'm just explaining it to you. So microfinance. So let's move to next slide. So agriculture, it is 18%, 18%, 18%. For microfinance, it is 7.5%, 7.5%, 7.5%. And advances to weaker section, this is slightly more in RRBs. So it is 15% for RRBs and 12% for small finance bank and uh, commercial banks or foreign banks with more than 20 branches. For primary urban cooperative bank as well, the total priority sector target is of 40%, whichever is higher, and it should be increased to 75%. So original was 40, should be increased to 75. Recent amendments made the target 60. Again, applicable from 1st April 2026, not made applicable yet. In micro enterprise, they should contribute 7.5%, and to weaker section 12%. For small and marginal farmers, the targets uh, are 8%, 9%. There is a gradual increase, you can see. So in phased manner, RRB prescribe gradual implementation from 8 to 9, 9 to 9.5, 9.5 to 10. And for weaker sections, for RRBs, the target is 15%, and for other commercial banks you have seen, the target is 12%. And again, there is a gradual increase. Targets and sub targets. So for all domestic banks and foreign banks with more than 20 branches, uh, they must ensure lending to NCF, so non-corporate farmers, that does not fall below the system-wide average of 3 years. This is important. Now, how do we compute adjusted net bank credit? So, first we need to compute net bank credit before computation of adjusted net bank credit. And how do we compute net bank credit? We simply reduce the bill discounted with with RBI from the bank credit. So, first we have bank credit. From this, we deduct bills which are discounted with RBI, and then we'll get our net bank credit. In this net bank credit, we add deposits with NABARD, NHB, SIDB, Mudra in lieu of shortfall. We add every priority sector lending certificate which has been purchased. But we deduct all the eligible exemptions like long-term infra bonds, affordable housing bonds, and we add certain investment which are eligible under priority sector lending like securitized assets, bonds under special RBI schemes. So, and after doing this addition subtraction, we get A and BC. So, from net bank credit, so this is 3, we add 4, which is eligible amount for exemptions on issuance of long term bonds. From this, we deduct advances extended in India against incremental FCNR deposits which qualify for exemptions from CRR, SLR. We deduct, so we add this outstanding amount, we deduct eligible amount for exemption, we deduct advances, and we also deduct investment made by public sector banks in recapitalization bond. We add other investment which are eligible, so we deduct this, we add this. We subtracted face value of securities acquired and kept under HTM category, and we add bonds or debentures in non-SLR category under HTM category. So we get adjusted net bank credit. And for UCBs, we also add investment made after August 30, 2007 in permitted non-SLR bonds held under HTM category, and we'll get adjusted net bank credit for UCBs. So in short, we uh, get net bank credit. So bank credit in India minus bill discounted plus deposits with NABARD, NHB, SIDB, or other institutions like Mudra in lieu of shortfall. We add them. We add priority sector lending certificates which are purchased. We deduct eligible exemptions. We get adjusted net bank credit. Now, if there's a prudential write-off in corporate or head office, we also subtract them from priority sectors and all other sectors. Then it should be write-off. Keep that in mind. For all type of loans, investment which are treated as eligible for classification under priority sector, they should also form part of ANBC. And small finance banks, they should also follow RBI norms in operating guidelines pertaining to treatment of grandfather loans for computation of ANBC. Now, what are the targets? What are the adjustments for weighing in PSL achievements? To address uneven flow of priority sector lending across India, RBI assigned weights to priority sector lending achievements depending on per capita PSL credit in India. So, say if the PSL is less than the flow is less than 6,000, then the weightage is 125%. That is, bank get extra credit for lending here. If there is normal flow, weightage is 100, and if there is a high credit districts, then 90% of weightage will be provided. That is lower credit for achievements to discourage over concentrations. And this is uh, for commercial banks. RRBs, UCBs, LABs, and foreign banks are exempted. Keep that in mind. So RRBs, local area banks, so they are exempted. Categories of priority sector. So we have 9 categories. So you find that there are 8, but in actual reality we have 9. Weaker section was not there earlier, but it was added later on. So we have agriculture, MSME, export credit, education, housing, social infra, renewal, others, and weaker section. So 9 in total. Let's discuss each of them. So agriculture is the largest and most important category under PSL, given its contribution to Indian economy and rural livelihood. It includes farm credit, so loans directly to farmers for crop cultivation and allied activities like dairy and poultry, agriculture infrastructure, loans for creating infrastructure. Now there is a limit up to 100 CR per borrower. Ancillary services loans for activities like food and agro processing, supply chain services. Specified deposits, so bank deposits with NABARD earmarked for agriculture development, small and marginal farmers, so specific special loans including lending to self-help groups and joint liability groups. And then there is on lending, so loans given by banks to NBFCs or microfinance institutions, which in turn lend to farmers. MSMEs, MSMEs are the backbone of India's infrastructure sector. We'll have a separate unit discussing MSME, and we also have a separate unit discussing agriculture financing. So we'll discuss all of them in detail. So PSL includes all bank loans to MSMEs provided they follow RBI guidelines. Factoring transactions with recourse, so where the assigner is an MSME, including through TREDS, which is trade receivable discounting system, loans to Khadi and village industry sector, and other finance that supports MSME operations. So all of them are included under PSL, uh, priority sector lending. Export credit, it is not applicable to RRBs and LABs. Keep that in mind. So export credit includes pre-shipment finance for raw material, packaging, etc., and post-shipment finance for goods already shipped. Their uh, limits actually depend on type of banks. So for domestic banks or small finance banks, export credit up to 2% is permitted. For foreign branches with foreign banks with 20 or more branches, it is same 2%. And for foreign branches with less than 20 branches, foreign banks with less than 20 branches, then they can contribute up to 32% in export category. Education, it is simply the loan to individuals for education purposes. We have discussed education loan in detail. I hope you recall. Housing loans. So it is loans to individuals, loans to government agencies, to individuals for purchase, construction, or repair of the dwelling unit, to government agencies for building housing loans or rehabilitation slum dwellers, loans for affordable housing projects, for loans to housing finance companies, and outstanding deposits with national housing banks. All of them are included under PSL, priority sector lending. Social infrastructure. So loans for creating infrastructure that supports social well-being such as school, drinking water facilities, sanitation facilities, it is included. And on lending by microfinance institution for these purposes are included under PSL. Renewable energy, so loan for clean and sustainable energy projects like like solar power projects, windmills, biomass, micro hydel projects. So non-conventional energy-based public utilities, so they are included in renewable energy. Then we have others. So it covers social lendings that does not fall under the above categories. Loans to individual self-help groups, joint liability groups for social needs, loans to distressed person to repay money lender, to state-sponsored organization for a scheduled caste or scheduled tribe communities, or loan to startups. All of this is included in others category. Then we have this ninth category, weaker section. It includes loans uh, to certain categories which require special attention, like small and marginal farmers, artisan and cottage industries. But the loan value should not exceed 1 lakh rupees. Uh, for weaker section group, keep that in mind as well. Uh, to loans provided to beneficiary of government schemes, scheduled caste and scheduled tribes, beneficiary under differential rate of interest scheme, self-help groups, distressed farmers, individual women borrowers, person with disabilities, and minority communities as well. Uh, Minority communities as notified. All right. So notified minority communities and Pradhan Mantri Jan Dhan Yojana overdraft accounts are may also be classified in this speaker section group. So what happens if the bank does not meet the target? So the Reserve Bank of India mandates that bank must lend a fixed percentage of their loan to priority sector. If the bank fails to achieve this target, they must contribute the shortfall amount to certain funds which are prescribed by RBI. So where this contribution goes, it goes into RADF. RADF is Rural Infrastructure Development Fund. It is managed by NABARD, and other funds which are managed by NABARD's, SIDBI, Mudra, National Housing Bank. So the contributions can go there as well. From 2021, particularly March 31st, 2021, urban cooperative banks are also required to contribute. The interest rate, tenure, term deposits, they all are to be fixed by RBI. Contributions are not voluntary, keep that in mind. They are compulsory penalties for non-achievement. And shortfall calculation is again as per RBI's master direction. Common guidelines for priority sector loans, rate of interest. The rate of interest on PSL loans, it is regulated by RBI's directives. There's no service charge levied for self-help groups or joint liability group members up to 25,000 rupees. Record keeping. So bank must maintain registers recording date of application received, date of sanction, date of rejection, disbursement, and reasons for rejection as well. Acknowledgement should be there. So bank must provide a written acknowledgement for every application, and applicants must be informed in writing of sanctions or rejections within a time limit set by the bank's board. Other modes of lending to priority sector. So apart from direct lending, banks can meet PSL obligations through various alternative instruments like investment in securitized assets. So bank can invest in securitized assets originated by other banks or financial institutions. Again, they are subject to certain conditions that the assets must qualify as PSL and follow RBI securitization guidelines. The total increase charged to the ultimate borrower cannot exceed external benchmark rate or marginal cost of lending rate plus appropriate spread, and the asset originated by MFIs comply with RBI norms are exempted from the interest cap. Loan against gold jewelry are not eligible for PSL classification. Keep that in mind as well. Then you can transfer of assets through direct assignment or outright purchase. So similar rule for securitization applies. Here, bank must report only the actual disbursed amount to PSL borrowers and not the premium paid in the transaction. Then we have interbank participation certificates. It is not applicable on UCBs, urban cooperative banks. IBPCs for short, interbank participation certificate for short for IBPC. They allow banks to share risk by buying or selling loans among themselves. If IBPCs are bought on a risk sharing basis, they can count towards PSL. For export credit, priority sector status is from the perspective of the purchasing bank, and RRBs can issue these certificates to scheduled commercial banks exceeding 75% of their outstanding loans. Then we have priority sector lending certificates. Bank that exceeds their PSL target can sell excess lending in the form of certificates. Bank that fall short can buy these certificates to meet the target. The underlying loan must be originated by bank and comply with RBI guidelines. Coordination between bank and NBFC. So there are two routes: on lending to NBFCs and co-origination of the loans. So banks can lend to NBFCs on lending to priority sector, meaning to say bank will lend to NBFC and then NBFC will lend to the priority sector advances. It is maximum up to 5% of total PSL. Co-origination is where bank and NBFC jointly finance loans at the facility level, sharing risk and capital. Other aspects: interest subvention scheme for crop loans. So farmers can get short-term crop loans up to 3 lakh rupees at 7% per annum. The government provides interest subvention, that is the subsidy, to banks to cover this reduced rate. And NRLM scheme interest subvention. So for women self-help groups under NRLM, it is provided. The scheme provides subvention of the difference between lending rate and 7%. Now let's check your progress. Housing loan granted to individual up to dash for construction of houses in metropolitan centers with a population above 10 lakhs are treated as priority sector. So it was 3.5 million. Earlier it is 3.5 million, but now this has been raised to 50 lakhs, so 5 million. Currently it stands at 5 million. Education loan again for studies, it earlier it was up to 20 lakhs, now it is up to 25 lakhs. So for this question, 20 million is the 2 million is the correct answer. Priority sector advances, scheduled commercial banks. What is the target? The target is 40%. So B is the correct answer. The government provide interest subvention in respect of short-term production credit up to they provide up to 3 lakhs and it is 2% and 3 lakhs. So A is the correct answer for this question. Now let's do some practice questions. Consider the following statement regarding evolution and applicability of priority sector guidelines in India. So we'll follow elimination method. Let's read statement number 1. Formalization of priority sector in 1972 was based on recommendation by an informal study group constituted by RBI in May 1971. This is correct. So option B gets eliminated. Now we are sure B is not the correct answer. Now let's read statement number 2, which is common in CND. The 1980 PSL directive required commercial bank to immediately allocate 40%. No, uh, a timeline is given till 1985, not immediate. So 2 is not the correct statement, making C and D incorrect. So we are left with only option A. So without going to read further statements, we can just mark option A and proceed. Consider the following statements regarding priority sector norms and targets. Identify which of the following are correct. Domestic commercial banks and foreign banks with 20 or more branches have a PSL target of 40% of ANBC or CEOBE, whichever is higher. So this is correct. But even if we have not read this statement, we were not into any trouble because this is given in every option. So now let's read statement number 2. Foreign banks with less than 20 branches have a PSL target of 75. No, they also have a target of 40, not 75. So 2 is incorrect. So C and D gets eliminated. Here 3 is common. Now 4 is the only statement which differentiates these options. So let's read statement number 4. All banks have a uniform agriculture lending target of 18%, out of which 10% should go to small and marginal farmers. So the statement is correct. All banks except foreign banks, which is implied uh, banks with 20, less than 20 branches, all commercial banks have a uniform target of 18%. So if it takes it implied, which is in this case, so all banks, let's say, except this is correct. So B is the correct answer for this question because statement 4 is correct. Option A, let's 5 and 6 are correct, so there is no need to read these statements. If you have any doubt with respect to this statement, all banks have uniform agriculture target. So if let's make it all commercial, scheduled commercial banks. So I'm just tweaking this statement a bit. All scheduled commercial banks. All right. So then it will be correct. Let's move on to question number 3. Consider the following statement regarding adjustment with for weights in priority sector lending for less than 6,000 district 125. This is correct. So B gets eliminated. District with higher per capita flow are given this incentive by applying a weight of 90%. This is also correct. The weightage framework applies equally to all banks, including RRBs, UCBs, LABs, and foreign banks. So they are actually exempted. So 3 is not correct. So 1 and 2, making option A as the correct answer for this question. Which of the following statement regarding agriculture category under priority sector lending are correct? Farm credit include loans to individuals and entities engaged in agriculture and allied activities. So this is correct. Infrastructure ceiling is 100 CR, not 50 CR. So that's why this is incorrect. So 1 is correct. C gets eliminated. D gets eliminated. Let's read statement third. Bank can lend to NBFCs and MFIs for on lending in agriculture. Yes, they can do. So this is correct. So B is the correct answer for this question. Which of the following statements are true regarding PSL? So even if we do not read statement number 1, it will not harm us because it is provided in every option. It includes loan to KVIs. Yes, it includes loan to KVI. So this is correct. Now let's read statement number 3 directly because in other statements 2 is also provided, but 3 is in A, B and C. So if 3 is correct, let's read statement number 2 as well. Export credit is not applicable to RRBs and LABs, so this is correct. So that's why C is not correct. It is eliminated because it does not provide option number 2. Now let's read statement number 3. If we read statement number 3, we'll get our answer, uh, or we'll move forward to statement number 6 then. Housing loans under priority sector lending includes loan for construction of schools. No, it is not for construction of school, but for the dwelling units. So 3 is not correct, and hence A and B are not correct. So we can simply mark option number D and we can proceed to our next question. Which of the following statements are true regarding weaker section categories for priority sector loans? Small and marginal farmers are eligible for priority sector loans under weaker section categories. Yes, they are. So this is correct. Option B gets eliminated. This is 1 lakh, not 2 lakhs. So this is not correct. So statement 2 is not correct. So D gets eliminated. 3 is common in both of them. Even if we skip statement 3, it will not harm us. Statement number 4, let's read. Overdraft facilities may be classified under weaker section. This is correct. 4 is not there in A. So C is the correct answer for this question. Which of the following statements are not true regarding priority sector lending guidelines? Banks with shortfall in priority sector lending are required to contribute to RIDF or other funds. So this is correct. So statement 1 is correct. C gets eliminated. So, sorry, it is asking about not true statement. So we get our answer just by reading the first statement. So here statement 1 is correct. 1 A, B and C states that statement 1 is not correct, which is not true. Statement 1 is actually incorrect. So we get our answer. C is the correct answer. So see, even if without reading all these statements, you get your answer. You get your answer quickly. If you want to read other statements, we can read. Let's read it. Okay. Only priority sector banks are required to contribute to RIDF. Uh, so this statement is not correct. No loan related service charge. This is for 25,000, not 50,000. So not correct. Banks must maintain a register recording the date of receipt, sanction, rejection. So this is correct. Banks are not required to issue acknowledgement. They are required to issue. That's why this is not correct. So see, 2, 3 and 5 are not correct. We, even without reading all the statement, we could have clearly marked the correct answer and moved forward. Which of the following statement regarding priority sector lending and related guidelines are correct? Investment in securitized assets originated by MFIs are exempted from the interest cap. This is correct. So 3 C, option C gets eliminated. It does not include statement 1. Interbank participation certificates purchased by banks are not eligible for priority sector classification. They are eligible, hence the statement is not correct. So option B gets eliminated. Now let's jump to statement number 4. Loans granted by bank against gold jewelry are eligible. No, they are not eligible for PSL status, and this is not correct, making option D incorrect. And we can just mark we can just mark our correct answer option A and move forward. In this particular video, we'll understand about short-term loans, medium to long-term loans, KCC, and selected activities under agriculture financing. We'll do some practice questions and we'll wind up this class. We know that India's economy is still heavily dependent on agriculture. So nearly 70% of people depend on agriculture for their livelihood. Farmers need credit to meet their agriculture expenses. Credit is provided in two ways. Number one is direct finance and number two is indirect finance. And also it is based on time period. So direct finance can be classified into short term loans and long term loans. Short term loans and long, medium or long term loans. So direct finance is loan given directly to farmers, and indirect finance is loans given for activities that support farming, like fertilizer distribution, storage, electricity for pumps. And then there's KCC, Kisan Credit Card Scheme, and it is a special credit scheme which we'll discuss uh, in a few moments. So, short-term loans are loans up to 18 months. These loans are for immediate farming needs like crop production. For example, crop loan uh, to buy seeds, fertilizer, pesticide, pay labor, KCC, Kisan Credit Card, loan for seasonal crops, and loan against gold ornament if used for agriculture purposes. So they are considered as short-term loans. Medium to long-term loans are those loans which are repayable for more than 3 years. So credit period is more than 3 years, and these loans are for investment in agriculture. So they are mainly for investment to improve the productivity. For example, farmland development, so leveling, uh, land, soil improvement, irrigation project, wells, tube wells, pumps, farm mechanization, tractors, harvesters, plantation, horticulture, and allied activities like dairy farming, poultry, goat, ship trading, fisheries, mushroom cultivation, etc. And then there's biogas plantation for renewable energies. Now, indirect finance, it includes credit for fertilizers, pesticide distribution, loan to state electricity board for rural electrification. So, you can see that this indirect finance is not directly provided to the farmers, but to improve the productivity. This indirect finance is provided for supporting activities like storage facilities, loans for crop spraying operations, advances given to state corporations for onward lending to weaker sections. So they mainly do a support function. Crop loan. So crop loan is to cover seasonal farming expenses like seeds, fertilizer, pesticide, irrigation charges, labor charges. And who can apply for crop loan? Who are eligible? So farmers, teen farmers, sharecroppers, all farmers are eligible for crop loan. And how is this loan amount decided? So it is based on cost of cultivation per acre for particular crop, called scale of finance, and a margin of around 10% is kept aside for safety. Now let's discuss about Kisan credit card. So farmers are given a credit card to get easy access to credit. It covers cultivation needs, allied activities, and non-farm requirements. Implementation is done by all major banks and cooperative institutions across India. The objective of KCC is to provide a single window system to give farmers quick and adequate loans for crop cultivation, post-harvest expenses like storage, transportation, household consumption needs, for maintenance of farm assets like repair of pumps, like pump repair, and allied activities like dairy, fisheries, etc. And then who is eligible? So be it farmer, be it teen farmer, rural leases, sharecropper, self-help group, joint liability groups of farmers, all of them are eligible for this Kisan credit card. Now let's discuss about fixation of credit limit. So the category of farmers is divided into two types. Number one is marginal farmers. So mainly three types. One is marginal, one is small, and then we have others. So marginal farmers are farmers who hold land up to 1 hectare. Then there are small farmers who hold land for more than 1 hectare up to 2 hectares. And then there are other who hold up more than 2 hectares. So short term credit limit for crop cultivation for this other uh, category, it is determined by scale of finance into cultivation area, and then we add 10% extra post harvest and household needs expenses, 20% repair and maintenance of assets, and for every subsequent year there is a 10% increase in every year for cost escalation. And then there are term loan components for investment, they are also added to the previous year. For farmers with multiple crops, this limit is calculated crop wise, and 10% cost escalation is added for each year. If cropping pattern changes, the limit can be revised. For term loan, so long term investment credits for land development, irrigation, purchase of farm equipments and allied activities, amount depends on unit cost of assets and repayment capacity of the farmer. The maximum permissible limit is a fifth year short term loan limit plus estimated long term loan requirement. So it is treated as overall KCC limit. Now there are sublimits. So short term loan sublimit for crop loan, which is covered under interest subvention scheme. Then there is a term loan sublimit for loan term investments, which is withdrawn in installments, and both these limits together form the total limit for KCC. Now let's understand it with the help of an example. So suppose there is a small farmer cultivating multiple crops. Land holding is 2 acres. Cropping pattern is paddy 1 acre. The cost is 11,000, and for sugarcane cultivation the cost is 22,000. Then there are some investments or allied activities. So there is establishment of 1+1 dairy unit in first year, which costs 20,000, and then there is replacement of pump set in third year, which costs 30,000. So for first year, the crop loan component for first year will be, we add this 11,000 and 22,000, we get 33,000. Then there is 10% towards post harvest and household expenses, we added 3,300. Then there is 20% towards maintenance, so it is 6,600. For first year we get our limit, it is 42,900. For every subsequent year we'll just add 10% to it. So 10% of first year is 4,300. So we have just rounded off this 42,900 into 43,000, and that's why we get 4,300. Then for third year add 10%, fourth year add 10%, for fifth year just add this 10%, and we get the total crop loan limit of 62,800, which we can round off to the nearest thousand, which is 63,000. Now this is crop loan amount. We also have these investment in allied activities, so we'll just add them in term loan component. So for first year, uh, 1+1 dairy unit in first year, unit cost per animal, so 20,000 into 2, which comes out to be 40,000. And then there is a replacement of farm set, which is 30,000 here. So which is 30,000, just add this 30,000 and we get term loan amount of 70,000. We add the 63,000 and 70,000, and we get our maximum permissible limit. For marginal farmers, those with very small land holdings, basically land holdings of up to 1 hectare, they are given a flexible loan limit of 10,000 to 50,000. This is provided as a flexi KCC, and it depends on the size of land holding, type of crops grown, post harvest needs, other farm expenses, small term loan requirements like buying farm equipment, starting small dairy or poultry unit, and the branch manager decides the amount. So this limit is assessed by the branch manager without linking it directly to the land value. Composite KCC limit is fixed for 5 years, but it can be increased if cropping pattern or finance requirement changes. Now let's understand KCC facility for animal husbandry and fisheries. This extension of KCC covers farmers engaged in dairy, poultry, sheep or goat farming or fisheries. Then who is eligible for fisheries, inland fisheries or aquaculture? There are fish farmers, teen farmers, self-help groups, joint liability groups, women groups who own or lease ponds, tanks or water bodies, and they must have proper authorization for fish farming. And for marine fisheries, those who own or lease fishing boats or vessels with necessary license for sheep fishing or mariculture. Poultry and small ruminants. Farmers or groups rearing poultry, goat, sheep, pig, rabbit, etc. They may own or lease sheds. Then we have dairy farming. So individual or group farmers who owned or rented or leased dairy sheds. Then there's scale of finance. So it is fixed by district level technical committee DLTC, depending on the local cost. Uh, it covers expenses like feed, seed, medicines, electricity, rent, harvesting, marketing. So everything is covered for fisheries. Then for animal husbandry, it covers feeding, veterinary cost, labor cost, etc. And assessment is done for one production cycle as per the flow needs. Drawing power is based on the value of stock receivables and expected cash flow. With respect to repayment, it works like a revolving cash credit. So you can withdraw, repay, and again withdraw within the limit. Repayment schedule depends on the income generation and cash flow of the activities. Monitoring of end use. So separate accounts or smart cards are issued for monitoring. Bank officials visit the site to check proper use of funds. Then there are again periodic reviews by banks to continue, enhance or cancel the limit. Disbursement of the loan. For short term KCC, loans are like cash credit. There's no limit on transactions, either withdrawal or deposits. Farmers can use multiple channels for withdrawal. They can use branch withdrawals, checks, ATM debit cards. They can use the facility of business correspondence. POS machines can be used. Mobile based transaction at Agri input dealers and mandis can be used, and long term loans are disbursed in installments as per the plan. Issue of electronic credit card. All new KCCs are issued as smart cards, come debit cards. NPCI designed KCC cards and they are adopted by all the banks. If software does not allow composite card, bank may issue two separate cards, one for short term and for term loan. Now these facilities are available on ATM, micro ATM withdrawals, POS transaction, mobile banking and Aadhaar enabled cards. Periodic review of KCC. So banks are to review periodically for the enhancement cancellation, and if there is any natural calamity, the bank can um, reschedule, bank can extend the repayment period. For documentation, only one time documentation is required at the time of availment, and for second year onwards, a simple declaration may work. A simple declaration for crop raised and proposed. Rate of interest are as per RBI rules for agricultural loans. They are eligible for interest, subvention, subsidy, and prompt repayment or incentives from the government. Then the repayment period for short-term loans, it is linked to harvesting and marketing crops, and for term loans, it is usually 5 years, which is extendable if there is any requirement. Margin and security. So the margins are decided by the banks. Then there are no margins for loans up to 1.6 lakhs. Security norms are there. So hypothecation is only required for loans up to 1.6 lakhs. Beyond this, collateral security may be required. And online creation of charge on land records wherever it is applicable. Selected activities under agriculture finance. So before that, we need to also discuss that there are other features like insurance options. So crop insurance, asset insurance, personal accident, health insurance. So premium can be paid via KCC, and for loans can also be given against warehouse receipts which are linked to crop loan accounts. Uh, then let's move on to selected activities under agriculture financing. So bank provide different types of loan to support agriculture and allied activities. These loans help farmers and agri entrepreneurs to buy assets, develop land, improve irrigation, increase productivity, and set up businesses like poultry, dairy, horticulture. So let's go through each of them one by one. So first is agriculture term loan. The purpose is for purchase of farm assets like machinery, bullocks, etc. And it is for creating long-term agriculture projects like orchids, poultry farms, dairy farm, plantations, sericulture. And these loans are long terms and repayment usually exceeds 3 years. All types of farmers and even agricultural laborers can apply. And for with respect to documentation, for small loans, there's no need for documentation. For bigger loans, estimation and quotations are required, and for land-based projects, land records are required. Then for land development loans, it is mainly to improve farmland by activities such as land clearance, leveling and shaping land, making terrace, digging drains, fencing the farm, and any farmer who owns agricultural land can avail this loan. With respect to documentation, estimation cost reports are required, which are supported by an engineer's estimate. Minor irrigation loans. The purpose is to create irrigation facilities like digging new well, deepening existing well, laying pipelines, setting up sprinklers. Farmers who have a usual source of water are eligible for these type of loan. And documents require the estimate for civil work, quotation for equipment, land record. Basically, it is for ownership, proof, geologist certificate for water feasibility, and then there's a feasibility certificate from electricity board if electric pumps are used. Farm mechanization, promote modern farming machinery. To promote modern machinery in farming, these loans are provided, such as to buy tractors, power tillers, threshers, to repair of old machinery which is already financed by banks. For tractor finance, farmers should have at least 5 acres of irrigation land. This requirement can be relaxed if farmers offer deposits, uses machine for custom hiring, or show viable project values. Small and marginal farmers are encouraged to buy power tillers instead of tractors. Now, with respect to project viability, bank check soil type, crop pattern, availability of fuels, repair centers. For loan terms, margin money up to 25% depending on the project. Repayment uh, is between 3 to 9 years depending on the activity. Then there is horticulture loan to support fruit and vegetable cultivation, fruit orchids, short-term crop loans for banana, pineapple, for flowers. So horticulture loans are provided. All farmers with cultivable land are eligible for these loans. Again, with respect to documents, soil and water test report, land record, cost estimate, project report are required. Poultry farm loans. So these activities covered boiler farming or layer farming. Loans are given for sheds, equipment, purchase of chicks, feed, machines, etc. Dairy farming. The purpose is to support milk production and related activities. The coverage includes small dairy units, 2 to 4 cows, buffaloes, medium large dairy farming, which is run by trained entrepreneurs, milk collection, processing and distribution, production of milk products like cheese, butter, ghee, etc., and to support infrastructure like breeding farm, semen bank, artificial insemination centers, etc. Sericulture, the purpose is to finance for silk production. Now, there are phases of this activity like growing host plant, rearing silkworms, breeding cocoon, and processing weave silk. Loan for drip, sprinkler, and lift irrigation. So, drip irrigation is basically where water applied drop by drop to crop roots. It requires pumping units, pipelines, nozzles, sprinkler irrigation. So water is sprayed from above like rain using pumps, pipes, and sprinkler heads. And then there are lift irrigation. Water is lifted from low level sources like rivers, wells, or lakes using horizontal or turbine pumps. Land purchase to help small marginal farmers, tenant or share crop holders purchase agricultural land. Now there are certain conditions like land purchase is mortgage to the bank, and repayment is usually in half yearly or yearly installments, which is spread over 10 years with some grace period before repayment starts. Minimum support price. So, what is MSP? The minimum support price is the price fixed by the government of India to protect farmers. It ensures that farmers do not have to sell their produce at a very low price when market prices fall. Under MSP, government purchases agriculture produce from farmers at a pre-declared price even if market price is lower. Now, who implements it? So, it is implemented by Food Corporation of India. It is main nodal agency for procuring crops like wheat and rice. Then we have NAFED, National Agriculture Cooperative Marketing Federation of India. It procures oilseed and pulses. And then we also have CCI, Cotton Corporation of India, to procure cotton. Now, currently MSP is for 22 crops for Rabi and Kharif crops. And now, why is it important? So, because it prevents distress sale by the farmer and provide income stability. PM Asha. So, to strengthen MSP operation, the government of India introduced Pradhan Mantri Annadata Aay Sanrakshan Abhiyan, in short PM Asha, which includes price support scheme, price deficiency payment scheme, and private procurement and stockist scheme. So PSS, sorry, price support scheme. Yes, it is government directly buy crops at MSP. In price deficiency payment scheme, if market price is lower than any MSP, the government pay the difference to the farmer. And in private procurement and stockist scheme, private agencies are allowed to buy at MSP in pilot projects. Prime Minister Fasal Bima Yojana, also known as Pradhan Mantri Fasal Bima Yojana, earlier crop insurance schemes like our National Agriculture Insurance Scheme were running since 1999, and in 2016, the government launched PMFBI, replacing all old crop loan schemes. So, it was launched in 2016. It is managed by AIC, Agriculture Insurance Company of India, along with private insurance companies. Now, who can apply? It covers all farmers, including share crop holders, teen farmers, growing notified crops in notified area. But they should have insurable interest in the land and crop. Aadhaar card is mandatory, and the scheme is optional. It is not mandatory scheme. It is optional. Now, there are certain risks covered. There are some basic risk and add-on risk. So, basic risk include drought, flood, cyclone, landslide, mm, lightnings, storms, pest attacks, white spread crop diseases, natural fire, and then there are some add-on coverages like farmers unable to sow due to lack of rainfall. So, if there is unseasonal rain, it is covered in basic risk. Keep that in mind. Uh, then, if there is a post-harvest damage for 2 weeks due to cyclone or unseasonal rain. So, if there is a drought, it is basic. If there is a cyclone or unreasonable rain, post-harvest damage for 2 weeks, it is an add-on coverage. So, crops loss due to wild animal attacks, again, it is add-on coverage, localized risk. So, these are add-on coverages. Then there are certain exclusions which are not covered under the scheme, like losses due to war, nuclear risk, malicious or intentional damage, or preventable risk. Sum insured and premium. So, sum insured is decided by state or UT governments using either scale of finance or notional average value. Scale of finance is cost of cultivation fixed by banks, and notional average value is average yield multiplied by MSP or farm gate prices. There is a premium which is calculated by insurance companies, and farmers pay only a small part of the premium while the rest is subsidized by the government. Now, let's check your progress. Kissan credit cards are issued by farmers to what is the purpose? To meet their cultivation needs, non-farm requirements. So, D is the correct answer. Under farm mechanization scheme, loan is given for, it is given for farm equipment, to purchase farm equipment. So C is the correct answer. Scale of finance is decided by DLTC, district level technical committee, and a broiler operation under poultry farming. How many days old chicks are grown? It is 1 day. So B is the correct answer for this question. Now let's move on to certain practice questions. Which of the following statement about short term, medium term, long term and crop loans is or are correct? Short term loans include crop loans, Kissan credit card for raising crops, and loan against gold ornaments for agriculture purpose. This statement is absolutely correct. Medium or long term loans are for the purpose of minor irrigation, farm mechanization, plantation, have a repayment period of more than 36 months. Again, this is also correct. So 2 is also correct. So only 1 and 3 is eliminated, and only statement 2 and 3 is also eliminated. Now let's read statement number 3. Crop loans are primarily intended for the purchase of agriculture equipment and machinery. So it is for expenses like seed, fertilizers, not for purchasing equipment. Hence this is not correct. So B is the correct answer for this question. Which of the following statement about KCC are correct? The KCC scheme provides for credit cards, including electronic cards, to farmers based on their land holding for purchase of input, allied activities, and non-farm activities. So this statement is correct, and hence option B gets eliminated because it does not contain statement number 1. Now let's read statement number 2. The maximum permissible limit for farmers is determined solely by the amount of short-term credit taken in the 5th year. It is not solely determined by this amount. It also includes long-term loans, right? So 2 is not correct, and hence 2, 2, we got our answer. B is the correct answer. So you can use this elimination method. It saves a lot of your time. Now let's move on to question number 3. You need to calculate KCC limit. Land holding is 10 acres. Cropping pattern is 5 acres, 11,000. Groundnut, uh, 10,000. And then there's sugarcane, 22,000. So land holding is 15 acres, not 10 acres, because there are 3 crops. Then there's investment or allied activities. Establishment of 1 plus 1 dairy unit, 50,000. Purchase of tractor in first year, which is 6 lakh rupees. So for first year, we'll get 5 into 11,000, which is 55,000. 5 into 10,000, 50,000. 22 into 5, which is 1,10,000, and we get 2,15,000. We add for the post harvest expenses of 10%, which is 21,500, and 20% towards maintenance, which will be 42 and 5, 43,000. So it will be 64,500. So total crop loan limit for first year will come out to be 2,79,500. For second year, we just need to add 10% into it. So 10% is 27,950, which comes out to be, if we add both of these terms, it will be 3,07,450, right? Then for third year, we'll add 10%, which is 30,750. We get 3,38,200. Add another 10% to it. So this is for third year. We need to require for fourth and fifth year as well. For fourth year, 33820. Let's round it off to 33800. We'll get total crop loan of 0001. It is 3,72,000. Then again add 10% to it, 37,200. So we'll get if we add these, we'll get 4,09,200. So we rounded off to nearest thousand, so it is 4,09,000. Now, if we add 6 lakh to it, we get 10,09,000, and then we have to add one more lakh, we like 11,09,000. So C is the correct answer for this question. Now let's move on to question number 4. Which of the following statement are correct regarding the eligibility criteria for KCC facility for animal husbandry and fisheries? Only individual farmers are eligible? No. Eligibility includes more than individual. So self-help group JLGs are also included. So one is not correct. So A and C gets eliminated. 2 is common in both. 3 is common in both. 4 and 5 are different. Let's read statement number 4. Farmers involved in dairy farming are not eligible for KCC facility if they lease or rent their shed. This is incorrect. So 4 is not correct, and hence B is the correct answer for this question. Which of the following regarding KCC scheme is or are true? Don't panic if there are 9 statements. Use elimination method. Simple. Let's read statement number 1. Just by reading statement number 1, we can eliminate at least 2 options from this 4 options. So the KCC short term component allows for the number of debits and credits to be limited, ensuring farmers don't exceed the drawing limit. Now this is incorrect because there are unlimited debits and credit, there is no limit on it. Hence this is not correct, and this makes C and D redundant. Now let's read statement number 2. Banks are required to use a single card for both short term and long term with software solution tracking individual components. Now, banks are required to issue a composite card with appropriate software, but 2 separate cards may be issued. We have just read this. So, they are not always required to use a single card for both short term and long term components. Hence, this statement is not correct because until a composite card is not issued, 2 separate cards can be used. Hence, this is not correct. 2 is not correct. We get our correct answer. So, option A is the correct answer for this question. So, just by reading 2 statements, we solved this question which has 9 statements in it. Alright. So, there's no need to panic. Just read a few statements and use elimination method, and you will get your answers. Question number 6. Which of the following statements are correct regarding agriculture term loan and farm mechanization schemes? Agriculture term loans are provided for purchase of farm machinery, bullocks, and creation of assets like orchid development. So this statement is correct. For farm mechanization, bank finance only for the purchase of new tractors. No, they also purchase. They also finance for second-hand equipments. Hence, this statement is not correct. So two, and all statement not correct. One is correct. Hence, we get our correct answer. C is the correct answer for this question, even without reading statement number 3. Consider the following statements related to agriculture financing schemes. Under the Finance to Horticulture scheme, loans are extended to farmers for developing fruit orchards, including short-term fruit crops such as banana, pineapples, but not for vegetable crops like tomato or peas. So this statement is not correct. Which of the following statements are incorrect? So incorrect statements are being asked. So this is relevant for us. So only 4 and 2 and 5 gets eliminated because 1 is incorrect, and hence it should be included in options. The eligibility, so we don't need to read statement number 2. Let's read statement number 4, whether it is incorrect or not. The drip irrigation system applies water directly to the root zone of the crop in a slow, continuous manner through a network of pipe, but it is not suitable for crops like vegetable or flowers grown in open field. So this is incorrect because it is actually suitable for vegetables and flowers which are grown in open field, and hence this statement is not correct, making option D as the correct answer for this question. Consider the following statement regarding Pradhan Mantri Fasal Bima Yojana. The scheme is mandatory. No, the scheme is optional, and hence 1 is not correct. A and C gets eliminated. 2, 3, 4 and 5 is common. So D also gets eliminated because it has statement number 1. So B is the correct answer for this question. So in this particular unit, we'll first understand about NBFCs, what is a non-banking finance company, what is included, what is excluded. We'll understand about the bank borrowings, source of finance for basically for NBFCs. Then we'll move on to microfinance institutions. We'll understand what is a microfinance institution, what is exempted from registration. We'll understand about fair pricing code, and we'll end up with scale-based regulatory framework. Then we'll move forward to our questions. So let's start today's class. So what is a non-banking finance company? So a non-banking finance company is a company which is registered under Companies Act. It can be Companies Act 2013 or any previous company act that provide financial services like loans and advances, buying shares, stock, bond, debentures, or other marketable securities, leasing and hire purchase services, insurance business, or chit funds. Now, one thing which we need to understand is that non-banking finance companies are not involved in agriculture or industrial activities, buying or selling goods other than securities, of course, providing general services, and buying, selling, or constructing immovable property. So, if any company is engaged in these businesses, then will not call it a non-banking finance company. There is also a special category called residuary non-banking finance company, which primarily collects deposit in lump sums or in installments under various schemes. So why non-banking finance companies are important? Now, non-banking finance companies understand uh, local and regional markets better than a traditional bank. They have strong collection system. They have personalized services for customers. Transaction cost is low, and uh, the decision making is quick and prompt. Now, these advantages help NBFCs expand financial inclusion in India, especially in areas where banks have limited reach. We have also a special type of NBFCs called housing finance companies. Now, housing finance companies are specialized institutions that provide housing loan in India. They work alongside scheduled commercial banks to offer home credit, and housing finance companies have undergone several regulatory changes to align their rules with non-banking finance companies. Now let's understand about non-banking finance company, microfinance institution. So what is a microfinance? First, we need to understand that microfinance refers to providing small loans and financial services to poor and low income households. The goal is to reduce poverty, increase income levels, and improve the living standard. Now, microfinance in India can be delivered via various channels. This includes scheduled commercial banks, small finance bank, regional rural banks, which lend directly or via business correspondents and self-help groups. Then we have cooperative banks, we have non-banking finance companies, and then we have special NBFCs which are registered as microfinance institutions. Now, these microfinance institutions, these are NBFCs that specifically provide microfinance. And over the last decade, some microfinance institutions have been licensed to start universal or small finance banks. Now, let's understand a source of finance for NBFCs. Now, NBFCs have multiple source of funds, which includes public deposits, or this public deposit but requires RBI approval. Then second is debentures. So long-term debt instruments they can use to raise money. Then we have bank borrowings. So this is the major source of fund for NBFCs. This is the major source of fund. And then we have commercial papers, which is short-term borrowings. Now, with respect to bank borrowings, bank lend to NBFCs, which then use these funds to reach areas and sectors which are not fully covered by banks. These NBFCs, especially NBFCs microfinance institution, often serve priority sector. So bank lending to them indirectly contribute to the priority sector lending targets of the bank. And we have the regulatory aspect of the NBFCs. So RBI has also issued guidelines for collaborative lending between the banks and NBFCs, allowing banks and NBFCs to work together. NBFC is registered with RBI. So bank often provide loans and other financial support to non-banking financial companies. So these NBFCs uh, are engaged in various activities, but they are not banks. And to ensure safety, bank extend finance only to the NBFCs which are registered with RBI, except for a few exempted categories, which we'll discuss in a moment. Now, finance can be working capital. This finance can be working capital, can be term loan, or even for second-hand assets which are financed by the NBFCs. Large exposure norms apply, meaning bank cannot give unlimited funds to one NBFC. They have their limits. Now, NBFCs which are exempted from registration include microfinance companies. Again, it comes with certain conditions which you will understand in this unit. Later, we'll understand. Asset reconstruction companies, Nidhi companies, mutual benefit companies, chit companies, merchant banking companies, and for these exempted NBFCs, bank make credit decision based on purpose of loan. What is the purpose of loan? Asset quality and risk perception rather than the regulatory guidelines. Now, there are activities which are not eligible for bank finance. So, bank will not finance NBFCs for these activities. Bank cannot provide finance to NBFCs for certain activities as these are considered risky or inappropriate. Now, bill discounted or rediscounted by NBFCs, exemption being exception is there. So, bills from commercial vehicle sale which are drawn by manufacturer on dealers, they are exempted. So, bank must verify genuine sales using chassis or engine number. Now, investment in by NBFCs in other companies are not financed by the banks. Again, there are exceptions. So, stockbroking companies may get loan against share or debenture held as stock in trade. Bank will not finance for unsecured loans or intercorporate deposits which are given by NBFCs to other companies or to loans which are provided to their own subsidiaries or group companies. So, a bank cannot finance an NBFCs if the NBFC want to give loan to their own subsidiary or group company, or if NBFCs want to finance for subscribing to IPOs or buying shares in the secondary market, bank will not finance these activities. Now, there are certain RBI specific provisions. So, RBI set rules to guide what bank can or cannot do when financing the NBFCs. For finance leased or subleased assets, bank cannot directly enter into lease agreements with NBFCs for equipment leasing. Bank can only provide financial assistance. Bank can finance NBFCs which are engaged in factoring if the NBFCs operate under the Factoring Regulation Act 2011 and at least 50% of the income comes from the factoring activities and 50% of assets are receivables purchased or financed. The asset or income do not include bill discounting, and finance is secured by hypothecation or assignment of the receivables. When they are bridge loans or interim finance, so banks should not give short-term loans to NBFCs against pending capital or debentures issued. Then advance against shares, so bank cannot accept shares or debentures as collateral for loans to NBFCs. Guarantees, so bank cannot issue guarantees to cover intercompany deposit or loans taken by NBFCs. So they cannot issue the guarantee. Guarantee should not indirectly help NBFC to raise deposit from other firms or institutions. One exception is there that the banks may provide partial credit enhancement to bonds issued by NBFCs or housing finance company. Now, there are prudential ceilings for bank exposure to NBFCs. For single NBFC, excluding gold loan companies, the maximum limit is 20% of Tier 1 capital. For group of connected NBFCs, this limit raises to 25%. For single NBFC, mainly giving gold loans, so the maximum is 7.5% of Tier 1 plus Tier 2 capital, and to 12.5% if funds are on lent to infrastructure. Aggregate exposure to all NBFCs can be fixed by the banks for their internal sectoral limits, and aggregate exposures to gold loan denominated NBFCs, again internal sublimits within total NBFCs exposure. The key idea here is these limits ensure that banks do not overexpose themselves to NBFCs, especially risky categories like gold loan companies. Bank loan to NBFCs for on lending. So bank can provide loans to NBFCs specifically for lending, which means that the NBFC takes the bank's money and lend it further to priority sectors like agriculture, micro enterprises, housing, etc. However, this facility is not available to RRBs, urban cooperative banks, small finance banks, and local area banks. There are certain type of loans for on lending. Number one, loans to microfinance institutions. So banks other than small finance banks can lend to registered NBFCs, MFIs, and other microfinance institutions like societies and trust. These microfinance institutions must be a member of RBI recognized self-regulatory organization, SRO for short. So they must be a member of SRO. These funds can be used to lend to individuals, self-help groups, joint liability groups, and loans given by bank to these NBFCs count as priority sector lending under specific categories. So they count as PSLs. Loans to other NBFCs other than MFIs. So bank credit to registered NBFCs for onward lending is also eligible for priority sector classification, provided certain conditions are met. Then housing finance companies. So bank can lend to housing finance companies approved by National Housing Board for purchase, construction or reconstruction of individual houses, slum clearance and rehabilitation. So these loans are subject to specified ceiling and condition. Bank credit to NBFCs including housing finance company for on lending should be within 5% of the bank's total priority sector lending averaged over 4 quarters. Bank loan to non-banking finance companies, microfinance institutions. So first we need to understand what is a microfinance institution. So a non-banking finance company, MFI, microfinance institution, is a non-deposit taking NBFC, uh, excluding section 25 or section 8 companies. So section 25 or section 8 companies. So this is Companies Act 1956 and this is Companies Act 2013. So they are basically non-profit organizations. So NBFC is a non-deposit taking that fulfills the following condition, that the minimum net own fund is 5 crores, and for northeast region the minimum net own fund is 2 crores, and the qualifying assets should be greater than or equal to 85% of net assets. uh, so that means at least 85% of net assets must be qualifying assets. What is net asset? Net asset equals to total assets minus cash, bank balance and money market instruments. Money market instruments. The qualifying assets are the loans that meet the following conditions. So household income ceiling in rural areas should be less than 1,25,000 and should be less than 2 lakhs for urban or semi-urban areas. Loan amount ceiling is 75,000 for first cycle and for subsequent cycle it is 1,25,000. Total indebtedness, meaning to say the total amount of loan which can be given is 1,25,000 excluding education and medical loans. Loan tenure should be greater than or equal to 24 months for loans above 30,000 with prepayment allowed without penalty. So no penalty on prepayment. Loans must be without collateral, so no collateral is allowed. And the loan portfolio, meaning to say the loans, the purpose of the loan should be income generation. So 50% or more of the loan portfolio should be for income generation. Rest can be for house repair, education, medical, emergency, and repayment mode can be weekly, fortnightly, or monthly installments at borrower's choice. Income from the remaining 15% assets must comply with the regulations, and non-NBFCs, NBFCs which are not qualifying as NBFCs MFIs can lend to microfinance only up to 10% of their total asset. So, if it is a microfinance institution, it can lend up to 85%, and if it is a non-MFI, then 10% can go to microfinance. Microfinance institutions which are exempted from registration. So earlier in this unit, we talk about that NBFCs, MFIs are exempted from registration with RBI, but with certain conditions. Now, these are the conditions which should be met, which should be satisfied in order to skip the registration with RBI. So it should provide credit, which should be less than or equal to 50,000 for businesses or less than or equal to 1,25,000 for dwelling to poor people. They are licensed under section 25 or section 8 of the Companies Act and they do not accept public deposits as per RBI directions. But there are prudential norms for NBFCs MFI as well. So the capital adequacy should be greater than 15% of tier 1 and tier 2 capital, and tier 2 capital cannot exceed tier 1 capital. Uh, Asset classification should be there. Standard assets are assets where there is no default, risk is normal, and non-performing assets are assets where interest and principal is overdue for more than 90 days. Provisioning norms are to be followed for qualifying assets, non-performing assets. So, aggregate provision should be greater than or equal to the higher of 1% of outstanding loan portfolio or 50% of overdue installments and 100% where overdue is greater than 180 days. So, 50% where the overdue is greater than 90 days but less than 180 days, and if it is greater than 180 days then 100% for overdue. Loans covered by the guarantee portions. So there is no provision required for guaranteed portions. Provisions apply only to excess outstanding. Membership. So every NBFC's microfinance institution must be member of all credit information companies. The purpose is to submit timely and accurate borrowers data including loan amount, repayment status, outstanding balance, and to access borrowers data for better credit assessment, pricing of credit. So NBFC MFIs must follow interest rate and cost guidelines to ensure loans are affordable for buyers while remaining financial viable for lenders as well. Now, maximum difference, there's a margin cap. The maximum difference between interest rate charged and cost of funds is large for large MFIs where the portfolio is greater than 100 CR, it's 10%, and for other MFIs, it is 12%. Now, this interest rate charged, uh, the applicable interest rate is the lower of cost of funds plus margin or average base rate of the 5 largest commercial banks into 2.75. For example, MFI's cost of fund is 8%, margin allowed is 12%. So maximum rate can be 20%. RBI base rate method is 17%. So the lower of the two will apply. So the applicable rate will be 17%. So the lower of these two will apply. Variance in individual loans, so maximum difference allowed from standard rate is 4%. In order to prevent discrimination between the borrowers, processing charges are maximum 1% of the gross loan amount, and insurance cost, it should recover only actual insurance cost. Administrative charges must follow the IRDA guidelines. So the purpose is that these rules keep microcredit basically affordable while preventing microfinance institutions from excessive charges. Multiple lending restrictions are there, so there are rules to prevent over indebtedness and loan misuse. So NBFCs, MFIs can lend to any borrower they whether or not they belong to a self-help group. So borrower cannot join more than one self-help group, and maximum two microfinance institutions can lend to the same borrower. There is a moratorium period. So, first installment should be at least one cycle of repayment frequency. So, if the repayment frequency is fortnightly, then it is fortnightly. If it is monthly, then it is monthly. Loan violating these rules are recovered after prior loans are cleared. Fair practice code. So, NBFCs must comply with fair practice code. NBFCs, microfinance institutions, ensuring transparent and ethical practices. This applies in addition to the Journal NBFC's Fair Practice Code, including clear disclosure of interest rate, ethical recovery practice, and transparency in loan agreement. Monitoring of compliance. So, compliance is ensured through multiple layers: self monitoring by microfinance institutions, then there's industry associations, banks lending to MFIs. All microfinance institutions must join at least one recognized self regulatory organization SRO, and it is mandatory and follows its code of conduct. Purpose is that it ensures uniform standards, ethical behaviors, and risk management. And they also act as channelizing agent for the government schemes. So they can act as intermediaries for government scheme, for example subsidized loan for farmers or women entrepreneurs. So they disburse loans, manage repayment, and ensure borrowers benefit from these scheme provisions. Co-lending model, it is introduced in November 2020 to promote collaboration between banks and NBFCs for priority sector lending. Now, the basic aspects is that banks can co-lend with the registered NBFCs, including microfinance institutions, sorry, including this housing finance companies. So, NBFC's minimum share should be 20% of individual loans. So, that means 20% of individual loans must remain on their books. There is a master agreement between bank and NBFCs to define rules, responsibilities, and loan sharing mechanism. Bank must take its share as per the agreement, or discretionary rejection is there. So bank can reject loans after due diligence. For customer aspects, NBFCs serve as a single point of contact. Loan agreement must clearly define the role of NBFC and bank, and borrowers must be informed and give their consent. Rate of interest includes NBFCs and banks part of rate of interest, so it is all inclusive. Fair practice code applies both to NBFCs and banks, and if there is any complaint, it should be resolved within 30 days. With respect to operational aspects, separate account for banks and NBFCs share should be there. All disbursements, all transactions should be routed through an escrow account which is in the bank. Master agreement specifies how the repayment will be appointed, so how it will be disbursed, and each lender follows income recognition and asset classification norms, provisioning and reporting individually. So apportionment should be there. So master service agreement should specify the apportionment of repayment. And bank share is without recourse to NBFCs. That is, bank cannot claim extra from NBFCs if borrower defaults. Scale-based regulation for NBFC. So RBI implemented scale-based regulations from 1st October 2022. So it is implemented from 1st October 2022. It focuses on the size, risk, and activity of the NBFCs. So there are four regulatory layers: base layer, middle layer, upper layer, and top layer. Top layer should ideally remain empty. So base layer, this is the smallest layer. Low risk NBFCs are put in base layer. Medium risk NBFCs or moderate size NBFCs are put in middle layer. High risk NBFCs or large operation NBFCs are put in upper layer. And systematic, important, very high risk should be there in the top level, and it should be ideally be empty. There are categorization rules. So NBFCs P2P, NBFCs AA, account aggregators, or NBFCs without public fund or customer interface should always be there in the base layer. Deposit taking NBFCs, CICs, housing finance companies should be there in the middle or upper layer. NBFCs, microfinance institutions or guarantee companies should could be in any layer depending on their scale, and government owned NBFCs should always be there in the base or middle layer. Now let's check your progress. Bank can extend dash to NBFCs. So working capital loan, yes. Term loan, yes. Bank guarantee for obtaining deposits, yeah, no. So A is correct, B is correct. So D is the correct answer for this question. Of the following categories of NBFCs, dash is not exempted from registering with RBI. So housing finance companies are not exempted. So B is the correct answer. Banks can finance NBFCs for financing second-hand assets. So financing individual to subscribe IPO, this is not allowed. Unsecured loans, no. Investing in shares, no. So C is the correct answer for this questions. Now let's move on to some of the practice questions. We'll use elimination method to determine the correct answer. All right. So consider the following statements regarding NBFCs and microfinance institutions. NBFCs are registered under Companies Act 1956. So yes, they are registered under Companies Act 1956. Also, any other Companies Act, they are registered. So one is correct. So one is correct, meaning to say C cannot be the correct answer. So C is eliminated. NBFCs can engage in business of lending, hire purchase, insurance, and chit fund. So this statement is absolutely correct. So 2 is correct. So 2 is not there in A, and hence A cannot be the correct answer. Only B and D are left. So let's read statement number 3. NBFCs include institution whose principal business is agriculture or industrial activity. So this statement is incorrect. That means statement 3 is not correct, and we are left with only option D. So option D is the correct answer. Let's read other statement as well. But by following this method, you can easily determine the answer without going through all the statements. So it will save your time. So HFCs are type of NBFCs that focuses on providing housing credit. This is correct. NBFCs have high transaction cost. This is not correct. Microfinance aims to provide small loans and financial services to low income households. This is correct. So you can see, even without reading these three statements, we got our answer. Consider the following statement regarding bank finance to NBFCs. So bank can provide term loan and working capital facilities to all RBI registered NBFCs. This is correct. So one is correct. So C is eliminated. Let's read. Statement number 3 and 4 are common here, here, and here. So there's no need to read statement number 3 or 4. Let's read statement number 2. NBFCs dealing in second-hand assets uh, are not eligible for bank finance. So they are eligible, hence this is not correct. So all statements not correct. 2 is not correct. 2 is not correct. And we got our answer. So A is the correct answer for this question. Consider the following statements regarding activities not eligible for bank credit. Banks may rediscount bills discounted by NBFCs only if they arise from sale of commercial vehicles and are drawn by manufacturers on dealers. This is correct. Banks can provide finance to NBFCs for further lending to individuals for subscribing IPOs. This is not correct. So 2 is not correct, and hence we got our answer. B is the correct answer for this question. Which of the following statements are not correct regarding banks' exposure to NBFCs? Exposure to single NBFC is capped at 25%. So this is 20% and not 25%, and hence this statement is not correct. Which of the following statements are not correct regarding a bank exposure to NBFC? Exposure to single NBFC is capped at 25%. No, it is capped at 20% and not 25%. Hence, this statement is not correct. So one should be there. One is there in A, one is there in C. All statements are correct. This cannot be the correct answer because this is not correct. And statement number 3, if you read it, exposure to groups of connected NBFCs should not exceed 30%. It should be 25% and not 30%. And hence, this statement is not correct. So C is the correct answer for this question. Which of the following statement about NBFC's MFIs is or are correct? NBFC MFI must have a minimum net owned funds of 5 CR except for those in northeastern region, which requires 2 CR. This is correct. So B gets eliminated. 2 is there in every statement. So let's skip statement number 2. Maximum loan amount for first cycle is 1 lakh. So it should be 75,000 and not 1 lakh. So this statement is not correct. So 3 is not correct. Now 1, 2, 4, 5, 7 is common in all these statements. Let's see read statement number 6. NBFCs that do not qualify as NBFC MFI can extend microfinance loan not exceeding 25%. Should not be more than 10% and not 25%, and hence C is the correct answer for this question. Which of the following statements are correct regarding the prudential norms and exemptions applicable to MFIs? MFIs exempted from RBI registration can provide credit up to 50,000 for business and 1,25,000 for housing. So this is correct. So C gets eliminated. MFIs accepting public deposits are exempted from registration. So NBFCs not accepting public deposits are exempted and not public accepting public deposits. So 2 is not correct, and hence B is the correct answer for this question. Which of the following statements regarding NBFC's MFIs regulations are correct? Interest rate on individual loans can vary by maximum of 2%. It can vary by maximum 4%, not 2%, and hence B, C, and D gets eliminated. So option A is the correct answer for this question. Consider the following statements regarding co-lending model as per RBI guidelines. Bank can enter into co-lending arrangement with NBFCs from their own promoter group. No, this is not correct. So 1 is not correct, and hence B is the correct answer for this question. Consider the following statements regarding operational and customer related aspects under co-lending models. NBFCs is the single point of interference for customer. This is correct. So B gets eliminated. Co-lending transaction between bank and NBFCs must be routed through an escrow account maintained with the NBFC. No, it should be maintained with the bank, not NBFC. So statement 2 is not correct, and hence A is the correct answer for this question. Consider the following statements regarding scale-based regulation framework for NBFCs introduced by the RBI. The regulatory structure comprises 4 layers: base, middle, upper, and top. This is correct. So C gets eliminated. NBFCs P2P, A2A, NOFHC will always remain a base layer and not middle layer. So this is not correct, and hence B also gets eliminated. 3 and 4 are there in both A and D. Let's read statement number 5. Government owned NBFCs can be placed in base or middle layer. This statement is correct, and hence option D is the correct answer for this question. So in this particular unit, we'll understand about the criteria of MSME, what are the policy packages, what are the credit guarantee fund scheme for micro, small, medium enterprises. We'll do our practice questions and we'll wind up this class. So in August 1991, the Government of India introduced a new policy for small, tiny and village enterprises. This was during the era of liberalization, when the economy was opening up and allowing foreign competition. And earlier, small industries were heavily protected. But after 1991, the focus shifted from making them competitive in the open market. So government took some moves to support the infrastructure by providing the roads, by providing the power, industrial estates, by providing better technology and ensuring the quality standards. Now, SIDBI was created, Small Industry Development Bank of India, finance and support MSMEs, and the fund, Technology Development and Modernization Fund, was also created to help with the upgradation. And to protect MSMEs from late payment, the Delayed Payment Act was enacted, and in 1999, separate Ministry of MSME was formed. The government launched special schemes like CLCSS. So it is a credit linked capital subsidy scheme, basically to help small businesses to upgrade technology with subsidy support. Then a credit guarantee scheme was there, CGT MSC. So this is basically a credit guarantee scheme to provide collateral free loans. And in 2006, the Micro, Small and Medium Enterprises Act was enacted, giving a legal framework to define and promote MSMEs. Now, there are certain contributions from MSMEs and certain limitations are there. So, they largely contributed to the domestic production. There's a significant export earnings. They require low investment compared to large industry. Operational flexibility is there. They're easier to adapt to changes. Uh, there's a less dependency on the imports, promoting self-reliance. Import substitution was there. They contributed to defense production. They encourage technology-oriented industries, and they compete in both domestic and international markets. And there are also certain limitations, like a small capital base is there with micro, small, and medium enterprises. There's a huge dependency on one or two persons. There's a limited exposure to international market. There's a weakness in facing global trade pressures. R&D contributions are many times poor, and professional management is somewhat where the MSMEs lack. So there's lack of professionalism as well. Now let's move forward to MSME Act. So in July 2006, this act came into force. So this act came into force in July 2006, and this act changed the word industry to enterprise. Now this word enterprise, this include both manufacturing plus services. In 2020, there is a change in the classification criteria of these enterprises, and in 2025 this criteria was again changed. So earlier it was in 2020 and this is 2025. So basically in 2020 what was there, it was multiplied by 2.5 with respect to investments, and it is multiplied by 2 with respect to turnover. So investments were for micro enterprise it was 1 cr and turnover was 5. uh, In revised criteria, it is just multiplied by 2.5 for investments and multiplied by 2 with respect to turnover. So 2.5 for micro enterprises, 25 for small enterprises, and 125 CR with respect to investments in medium enterprises. With respect to turnover, it is 10 CR, 100 CR, and 500 CR. Now, these numbers are important for you, so please remember these numbers. and all MSMEs must obtain Udyam registration certificate. They must obtain Udyam registration certificate. It is mandatory. Composite criteria of investment and turnover for classification. So both investments and turnover are considered together. And if an enterprise exceed the limit in either investment or turnover, it moves to the next higher category, and it cannot move downwards unless it falls below the limit in both the criterias. And all units under the same pan will be treated as one enterprises. Calculation of investment in plant and machinery. So it is based on income tax returns of the previous year. For new businesses, a self declaration is taken till the first ITR is filed, and uh, it includes all tangible assets, excluding the land, building, furniture, and fittings. The value considered uh, is equivalent to the written down value as per the Income Tax Act and not the original purchase value. Keep that in mind. And GST is excluded in valuation. With respect to turnover, exports are excluded while calculating the turnover, and this turnover is again linked to IT Act, CGST Act, or GSTIN. After March 31st, 2021, the PAN and GSTIN are mandatory. And if an enterprise moves up in category, changes apply from first 1 year after closing of the financial year. So it is after 1 year from closing of financial year that these changes are applied if an enterprise moves up in the category. Policy package for MSMEs. So MSME lending is a part of priority sector lending, right? So bank have a sub target of 7.5% of NBC for MSMEs. So this is a RBI and PM task for recommendation for 20% year-on-year growth in credit to micro and small enterprise. So this is basically based on RBI and PM task force recommendation. There's a 10% annual growth in the number of micro enterprise account, and at least 60% of MSME micro small enterprise lending should go to micro enterprises. So there are certain key institutions and source of finance. So SIDB is there. It is an apex body for micro, small, and medium enterprise finance. It also coordinates with other institutions. Commercial banks provide both term loan and working capital. Then MSMEs also use venture capital, private equity, external borrowings, factoring, securities market, and to encourage MSMEs, the LLP Act was also enacted in the year 2008. A separate ministry was formed for MSME to provide policy support, online services, schemes, and MSME Act. It's basically focus on promotion, development, and competitiveness of the MSME. So it provides for skill and entrepreneurship development programs, technology upgradation assistance, cluster development and infrastructure support, and marketing assistance. Credit support schemes were also there. So, as I stated earlier, the credit guarantee was also provided to support collateral free loans to MSME. Then there is a platform, TREDS. So, this is a platform, online platform for bill discounting and trade receivables financing. Procurement, there's a procurement policy. So basically, central ministries, department, PSUs, they must buy 25% of the procurement from micro small enterprises. Then there's a certified credit counselors scheme. So it is launched by SIDB. They help MSMEs uh, for professional project reports to prepare the professional project reports. and this basically improves banks' credit decision making. Now, these applicants must complete MSME certification program by IABF. Delayed payments. So, as per the Act, payments to MSME must be made within 45 days. This is the maximum 45 days of supply, and if it is delayed, the buyer must pay compound interest at 3x of RBI bank rate. So, whatever the RBI bank rate is, you multiply by 3x, and this is the interest which the buyer must pay. RBI instructed banks to fix sublimits in working capitals to ensure timely payment to MSMEs. The problem with MSMEs is that they depend on big buyers and they hesitate to take legal actions due to fear of losing business. And this act basically uh, helps them. There's also a portal which was launched, MSME Samadhan portal, so they can file complaints regarding the delayed payments. TREDS. So what it is a online platform that helps MSMEs to get quick financing against their pending bills or invoices. Now, how does it work? MSMEs sell goods or provide services to large companies, PSUs, or government departments. Instead of waiting months for payment, MSMEs can upload these invoices on this portal, and multiple banks and financial institutions compete to finance that is to discount these invoices. There are three participants, sellers. So MSMEs can be the only seller in this transaction. Then there are buyers, so corporate government departments, PSUs can be the buyer, and there are financiers. So banks, NBFC factors, other RBI approved financial institutions, they can be the financiers. One thing which we need to also understand here is the factoring unit. So each invoice or bill upload is called a factoring unit. So if MSME creates it, it is a factoring, and if buyer creates it, it is called reverse factoring. All right. Now let's move on to performance and credit rating schemes for MSMEs. So National Small Industrials Corporation is the nodal agency here, NSIC. Ratings are given by empaneled rating agencies in consultation with Indian Banks Association. So MSMEs get an independent credible rating on their performance and credit worthiness. So this basically helps them to get loan faster and at a lower interest rate, and it improves their recognition in domestic and the global market. For a bank, it provides independent evaluation of the MSME strength and weaknesses, and it helps bank to assess the credit risk better. There are certain features that the rating considers both credit factors and performance factors. So credit factor is the finance, performance factor is operation, management, and other risk. There's a uniform rating scale across all agencies, and MSMEs can choose their preferred rating agency. Rating fees depends on turnover of the MSME, micro, small, and medium enterprise, and part of fees is reimbursed by this nodal agency, NSIC. Credit guarantee fund scheme. So the problem was that MSMEs often struggle to get loan because bank demand collateral security or third party guarantees. And in 2000, government and SIDB set up Central Guarantee Fund Trust for micro and small enterprises. In short, CGPMSE. So if an MSME cannot repay, the trust compensates the bank for the loss based on the agreed terms. And there are different schemes in this credit guarantee uh, trust for the uh, micro and small enterprises. So firstly, it is credit guarantee scheme for banks. So here the commercial banks, RRB, small finance banks, NBFCs, SHG-B, NSIC, they can lend. And the eligible loan size is up to 50 lakh for RRBs and small finance banks, and up to 200 lakhs, that is 2 CR for for scheduled commercial banks, should be NBFCs, and it covers both fund-based and non-fund based requirements. Th- Here no collateral is required or any third party guarantee is required. There are certain special features in this scheme. That is, there is a hybrid security product. So part collateral on part CGT MSC guarantee is possible. Joint lending is allowed. So if multiple banks or NBFCs lend, total cover up to 2 CR is possible. Guarantee period is for the tenure of the loan if it is a term loan, and for up to 5 years if it is a working capital loan. Interest rate is capped maximum at 14% per annum, and it includes a guarantee cost. CGS 2. So NBFC is registered with RBIs and fulfilling the CGT MSC norms, they can lend in CGS 2. Again, both fund-based and non-fund-based loans can be provided up to 2 CR, 200 lakhs. And for MSC retail trade, it covers up to 100 lakhs. So 1 CR can for loan up to 1 CR can be provided to retail MSME retail trade. Loans must be standard, not restructured, and borrower's activity should be ongoing. Loans above 50 lakhs to 200 lakhs need to be internally rated investment grade, and claims settled up to 75% of the amount in default, subject to payout cap chosen by the NBFC. So portfolio guarantee of up to 75% of the amount is provided. Mm. Okay, this annual guarantee fees was also, yeah. So when banks lend to borrowers under a guarantee scheme, they need to pay a guarantee fees to the trust. So the fees must be paid within 30 days of either submitting the loan batch or receiving a demand advice, whichever comes earlier. So this guarantee cover begins only after this fees is paid and realized. Uh, CGSSD, so it is a distressed asset fund. It is subordinate debt scheme for MSMEs. So the scheme was designed for stressed MSMEs. The MSME account should have been standard. So there are certain conditions that this MSME account should have been standard. The MSME must have been in regular operation and the account was stressed. Uh, so basically, the scheme supported MSMEs that were doing well earlier but became stressed around the pandemic time. PM Swanidhi, street vendors. So this scheme helps street vendors by providing them small loans. It was launched on 1st June 2020, and initially it was extended till March 2022. Then it was extended till December 2024. And the guarantee interest subsidy claim can be paid till March 2028. There are certain key features like the first loan can be provided up to 10,000, the second loan up to 20,000, third loan up to 50,000, and the repayment period is up to 3 years for the third loan. But to get the third loan, the second loan must be repaid properly. There are repayment conditions that for the second loan, the borrower must repay at least 6 months before being eligible for the next cycle. Interest subsidy is provided. A 7% subsidy on interest is given for second and third loan, and it is available only the account remains standard, not for the non-performing assets. Guarantee coverage is allowed. It means how much of the loan loss will be bear if the borrower defaults. For the first loan, 100% cover is there. For any fresh second loan, again 100% is provided, and for the third loan, the coverage ranges with maximum guarantee capped at 8%. Uh, for loans given before 1st June 2022, the earlier rules that were applicable, that those rules apply on these uh, loans. CGSCL, it is a co-lending, basically credit guarantee scheme for co-lending. The scheme was introduced to cover loans given under co-lending model. There are two models. Option one was joint lending. So both bank and NBFC jointly lend and guarantee is for the individual loan. Then there's option two, direct assignment. So only MLI money lenders, so banks or NBFCs registered with CGT MSC can pair under this option. So the important features are that the tenure for term loans, it is still the loan term, and for working capital it is 5 years. Eligible credit facility is up to 2 crores, secured loans with primary security, and for unsecured it is up to 1 CR. Hybrid security is possible. Part of the loan can have collateral, and the unsecured part can still be covered under the credit guarantee scheme. Credit guarantee coverage of 75% is provided for secured credits and 50% of unsecured credits. There are certain responsibilities of the lending institution, so they should conduct proper due diligence and monitor the accounts. They should report defaults and file claims on time, and they should continue efforts even after the claim is settled. So recovery efforts should be continued even if the claim is settled. Annual guarantee fees is 1% up to 5 lakh rupees of loan, 1.25% for 10 lakhs, and above 10 lakhs it is 1.5%. Additionally, risk premium may also be added, and the payout from the credit guarantee fund will be maximum 2x of the receipt. So fees plus recoveries from the previous year. Then there are certain credit facilities which are not covered under credit guarantee fund scheme. So loans already covered under RBI scheme or DICGC schemes, they are not covered. Loans covered under other guarantee schemes, micro loans up to 10 lakh rupees covered by Mudra guarantee scheme, loans violating any government law or RBI directive, loans with interest rate which are not in line with the RBI or trust guidelines, loans where guarantee has already been invoked, and loans with collateral or third party guarantee except under this hybrid security model. So these credit facilities are not covered by this credit guarantee scheme. Claim for claim settlement. So when a borrower defaults and the account becomes NPA, the bank or NBFC can invoke this guarantee. But again, there are certain conditions that they must inform the credit guarantee trust when account turns NPA by the end of next quarter. The claim must be filed within 3 years from the NPA classification, and the recovery action must be started. For settlement, it is 75% of the guaranteed amount, uh, and the remaining 25% is paid only after recovery proceedings conclude or when the legal decree becomes time barred. So 75% of guarantee amount is settled within 30 days if claim is valid, and the remaining 25% only after the recovery proceedings conclude. Cluster based approach. So what is a cluster? A cluster is basically a group of micro, small and medium enterprises which are located close to each other, usually in the same town, city or group of villages, that produce the same type of product or related products. These enterprises may share similar production method, technology, marketing practices, skills. So they also face common challenges like competition, quality control, access to credit, raw material supply. And these clusters have existed in India for centuries, and they continue to play a vital role in the economy. So, when I define cluster, a cluster is of two types. artisan cluster and industrial clusters. So artisanal clusters include textiles, handlooms, handicraft, and industrial clusters. They include engineering tools, garments, pharmaceuticals, rubber, etc. Um, and these clusters are not only important for exports but also for preserving the traditional skills and for creating jobs. Now let's talk about cluster financing. So cluster financing is when a bank adopts a cluster-based approach instead of lending to MSME one by one. It means providing banking services and loan facilities to entire group of micro, small, and medium enterprises in a cluster. This approach is efficient, cost effective, and this approach reduces the risk. So, there are certain advantages of cluster financing for banks. It includes that it is easier for the bank to work with recognized MSME clusters. Banks have more information about the group, making it easier to judge the risk. Banks can monitor the cluster as a whole rather than the individual scattered units. There's a lower cost of service by providing the borrowers. So and banks can design special packages for specific clusters. There are certain government and institutional support provided to the clusters. So Ministry of MSME runs programs like Scheme of Funds for Regeneration of Traditional Industries SFURTI and Micro and Small Enterprises Cluster Development Program to develop infrastructure and technology for MSMEs. Banks have been advised to increase the credit flows to minority clusters, and state level bankers committee must include cluster credit needs in their annual credit plans. Also, banks are encouraged to open MSME focus branches in cluster areas and even adopt at least one cluster per district. There are some common guidelines for lending to MSMEs. Now let's talk about them. So banks must follow certain rules and schemes to make credit more accessible for MSMEs. Number one is acknowledgement of application. So every loan application, whether online or offline, it must be acknowledged and given a serial number for tracking. Then there is collateral. So no collateral is required for loans up to 10 lakh rupees. For loans under Prime Minister Employment Generation Program, again, then there is no collateral required. Bank can also waive collateral for loan up to 25 lakh rupees if they feel comfortable, and instead of collateral, banks are encouraged to use the credit guarantee fund scheme to reduce their risk. Banks can sanction up to 1 crore under a single composite loan covering both working capital and the term loan needs. There's a general credit card scheme which provides easy credit access for all productive areas of the MSMEs. Then there's credit linked capital subsidy schemes which help MSMEs to upgrade their technology. There are certain conditions that the maximum loan amount can be 1 CR. The subsidy can be 15% of the plant and machinery cost. It is implemented through SIDBI and NABARD. There's a streamlining credit flow. So bank must provide a standby credit facility in case of repayment issues, provide additional working capital for urgent needs. Mid-term reviews of working capital limit should be there if business demand changes, and time-bound decisions on loan approvals are required. If MSMEs face stress, bank must follow RBI debt restructuring guidelines, and a special framework exists for the revival of the stressed assets. It applies to the unit with a loan exposure up to 25 CR. And this provides simpler and faster mechanism for turnaround. So banks must strengthen credit monitoring system and introduce e-tracking of MSME loan application. And public sector banks must open at least one specialized MSME branch in each district. These branches act as counseling centers for MSMEs in addition to the lending. Now let's check your progress. Keep that in mind. This question was based on 2020 criteria. So micro enterprise is one where the investment in plant and machinery does not exist. So with respect to investment, earlier it was up to 1 CR, right? But currently this has been changed, and the investment uh, now has been multiplied by 2. So it is 2 CR. Medium enterprise is one where the investment does not exceed. So it was 50 CR, now it is 100 CR. And within how many days from the date of submission of complete papers by a borrower, a loan application for 25,000 is to be processed as per the guidelines in force? It is 4 business days. So A is the correct answer for this question. Now let's move on to the practice questions. Which of the following statement about MSME in India is or are correct? The policy for small, tiny and village enterprises introduced in 1991 focused on replacing protectionist measure with competitiveness for MSME. This is correct, and hence B can be safely eliminated. The Ministry of MSME was established in 2006 to support MSMEs. So it was established in 1999, not 2006. So all of the statements cannot be correct because 2 is not correct. Now we just need to look into statement number 4. MSME in India have made significant contribution to defense production and technology oriented industry. So the statement is correct, and hence option C is the correct answer for this question. Which of the following statements are true about micro, small and medium enterprises? The MSME Act 2006 was notified in July 2006 and replaced the term industry with enterprise. So this is correct. Micro enterprise now have investment limit of 1 CR as per the revised guidelines. It is not 1 CR, it is 2.5 CR. So it is not 1 but 2.5, and hence the statement is not correct. Let's move on to statement number 3 now. Small enterprises are defined as those with with an investment limit of 25 crore and a turnover limit of 100 crore. So this statement is correct. Medium enterprises are required to obtain an Udyam registration certificate to operate. Again, the statement is also correct. The revised investment limit for micro enterprise is 2.5 CR and their turnover limit is 10 CR. So again, this statement is correct. So 1, 3, 4 and 5 are correct, making option A as the correct answer. Here I vaguely remember that I said 2 CR. So it is not 2, it is 2.5. For investment, it is multiplied by 2.5, right? Uh, and here, medium enterprise, uh, where the investment does not exceed. So earlier in 2020, it was 50, but now it has changed to 125 CR. So please keep that in mind as well. So let's move on to question number 3. An enterprise will be moved to a higher category if it exceeds the ceiling limit for either investment or turnover. So this statement is correct. Turnover of an enterprise will include export sales. So no, it excludes. So that's why this is not correct. For new enterprise, the investment is calculated based on the self declaration of the promoter until the first ITR is filed. So this is correct. So B is the correct answer for this question. 1 and 3 are correct. Read the following statements carefully and choose the correct option. Credit to MSME is a part of priority sector lending with a sub target of 7.5% percent of NBC for lending to micro enterprise. This statement is correct. Even if we have not read the statement, it would have not harmed us because it is there in every option. Let's read statement number 2. According to Prime Minister Task Force recommendation, bank must achieve 20% year-on-year growth in credit to medium enterprise. It is for micro and small and not medium, and hence this statement is not correct. So B can be eliminated. All statements can be eliminated. Now let's read statement number 5 and we'll get whether this statement is correct or not. The ministry, there's no need actually to read statement number 5 because this is incorrect. So, 1 is correct, we know that. 2 is incorrect, we know that. So, let's read statement number 6 and we'll get our answer. The public procurement policy for MSME mandates that 25% of procurement must be come from every central and ministry department should come from this MSE sector. So, this statement is actually correct. Hence, 6 cannot be an incorrect statement. 6 is not false. So, C is the correct answer for this question. Read the following statement carefully. As per the MSME ED Act, payments for suppliers made by MSME holders should be received within 30 days. No, it is should be within 45 days and not 30 days, and hence A and B gets eliminated. So the only statement now which we have to read is statement number 4. It will make the difference. A factoring unit is created when the MSME seller create an invoice or bill of exchange which is considered factoring. So the statement is correct and hence option D is the correct answer for this question. Consider the following statements regarding the performance and credit rating scheme for MSE. The performance and credit rating scheme help MSE by providing them with an independent evaluation of their credit worthiness. So this statement is correct. NSIC provides partial reimbursement of the rating fees to MSC. This is also correct. The scheme allows MSC to select any rating agency, even those not empaneled, so it should be empaneled. Hence, B is the correct answer for this question. Which of the following statements are correct regarding the Credit Guarantee Fund scheme for bank? 1. So, the credit CGS 1 is primarily intended for covering credit facilities extended by commercial banks, RRBs, NBFCs, and other eligible financial institutions. So this statement is correct. So B gets eliminated. The maximum credit facility covered under CGS 1 is 50 lakh for all type of lending institutions. So this is not correct. So 2 is incorrect and hence C gets eliminated. 1, 3 and 5, 1, 3 and 5 are there, 6 and 7. So let's read either statement number 6 or 7. Let's read statement number 6. The guarantee covered under CGS 1 applies only to loans extended to micro enterprise and does not cover loans for small enterprise. So it applies to both micro and small, and hence this statement is not correct, making option A as the correct answer for this question. Which of the following statements are correct regarding PM Swanidhi scheme? The PM Swanidhi scheme provides a third loan of up to 50,000 after repayment of second loan of rupees 20,000. This is correct. The minimum repayment period for the second loan is 12 months. To qualify for the third loan, it is 6 months, not 12. Hence, this is not correct. Interest subsidy of 3% for both second and third loan. It is actually 7%, not 3%. So, this is also not correct. So, only statement 1 is true. And hence, A is the correct answer for this question. Based on the credit guarantee scheme for co-lending, identify the correct statement from the following. It is designed to provide guarantee cover for loans under co-lending model. This is correct. 2 gets eliminated and D is also eliminated. because they don't cover statement number 1. So there's no need to read statement number 2, 3, no need. Let's read statement number 4. It will get us to our answer. The credit cover under CGSCL is available for the entire loan tenure or 10 years, whichever is earlier. So it is entire loan tenure or 5 years, not 10 years, and hence this statement is not correct. So this is not correct. So C is the only available correct option that we have. Which of the following statements about credit facilities under CGT MSc schemes are not correct? Loans covered by DICGC or RBI are eligible for the cover? No, they are not. So this is not correct. So D gets eliminated. There's no need to read statement number 2 or 4. Let's read statement number 3. A loan classified as NPA can have a claim invoked after 5 years. It is after 3 years, not 5 years, and B gets eliminated. Let's read statement number 5. The remaining 25% of the guaranteed amount is paid only when the borrower repays the full amount. It is also not correct. So, remaining 25% is paid on conclusion of the recovery proceedings, and hence C is the correct answer for this question. Which of the following statements about cluster based approach to financing MSMEs are correct? MSME clusters are defined as concentration of enterprises producing similar or complementary product services within a specified geographical area. This statement is correct. No need to read statement 3 and 4. Uh, let's read statement number 2 and statement number 5. Cluster financing aims to offer banking services to individual MSMEs. No, this is not correct. Cluster means the group of enterprises. Statement number 5. Banks are advised to open MSC focused branches in identified clusters, which can also serve as counseling centers for MSMEs. So this statement is actually correct. So 1 is correct, 3 and 4 they are correct, and 5. So D is the correct answer for this question. Consider the following statements regarding guidelines for lending to MSME sector. All MSME loan application must be acknowledged and given a running serial number. This is correct. So state number 3 is common, 6 is common. There's statement number 2, 4 and 5. These will make the difference. So let's read statement number 2. Collateral security is mandatory for all MSE loans above 5 lakhs. No collateral is required up to 10 lakhs, and hence this is not correct. C gets eliminated. The CLSS subsidy is calculated based on the loan amount. Again, this is not correct. It is based on the purchase price of the plant and machinery and not the loan amount, and hence D gets eliminated. So A is the correct answer for this question. In this particular video, we'll discuss about different government schemes like Deen Dayal Antyodaya Yojana National Rural Livelihood Mission, Deen Dayal Antyodaya Yojana National Urban Livelihood Mission. Then we'll discuss about Mudra loans. We'll discuss about Atal Pension Yojana, Pradhan Mantri Suraksha Bima Yojana, and we'll do our practice questions at last, and we'll wind up this class. So, without further ado, let's begin today's session. So, day NRLM, Deen Dayal Antyodaya Yojana National Rural Livelihood Mission, is a major Government of India program launched on 29th of March 2016. It replaced earlier scheme called Swan Jayanti Gram Swarozgar Yojana, and the main aim is to reduce poverty in, as the name suggests, rural areas by helping poor families to build strong community institutions, gain access to financial services, and improve their livelihood. Now, the objectives are very simple: to reduce the poverty, to provide access to the financial services, be it loan, be it savings, be it insurance, to promote financial inclusion, and to support the livelihood. The key features involve universal social mobilization. At least one person from each rural poor household is bought under self-help group. The beneficiary under the schemes, the composition is that 50% is from SC/ST group, 15% from minority, and 3% the PW people are involved, person with disability. Uh, the One of the main features is participatory identification of poor. So the poor themselves are part of the process of identifying eligible households. It is based on socio-economic and caste census data. Promotion of institutions of the poor, basically a formation of strong self-help group is there. So their federation at village and high level, so that poor can voice their needs and reduce dependence on the outsiders. And the already formed self-help groups are supported and they are made stronger. Training is provided to the poor to manage self-help groups, to improve their livelihood, skill developments, and basically capacity building. You can say is provided. There's a revolving fund and community investment support fund. So revolving fund helps the self-help groups to manage their credit needs and emergencies. And the CIF, Community Investment Fund, is given to federations of self-help groups for lending to self-help groups or supporting common economic activities. There's a feature of universal financial inclusion. So what does it mean? So ensuring that all poor households and self-help groups get access to savings, loans, insurance, pension. And this includes both demand side and the supply side. So demand side, the financial literacy, seed capital for self-help groups, and supply side, the coordination with the banks, the financial institutions. Interest subvention is provided. Interest subvention is nothing but a subsidy. So women self-help groups get loan at a reduced effective rate of 7% as the government pays the difference. Then this intensive versus non-intensive blocks. So intensive blocks, they get full staff support. It covers all activities. The non-incentive blocks, they get limited activities depending on the resource. And self-help group, of course, they play a very pivotal role. They're the foundation of this scheme actually. So mostly women come together based on trust and mutual support, and they are supported for 5 to 7 years until they become strong enough to function independently and come out of poverty. Financial assistance is provided to self-help groups. So as stated earlier, CIF revolving fund, a revolving fund of 10 to 15,000 is provided per self-help group. The purpose again is to strengthen the financial management and to build credit history. CIF, Community Investment Support, it is given in intensive blocks and it is managed by self-help group federations for lending or collective social economic activities. Interest subvention is provided. So for loans up to 3 lakh per self-help group, effective rate of 7% is charged. So effective rate is limited to 7% per annum. Banks accounts are opened, so savings account for self-help groups, saving account for individual members, self-help group federations, and then there are current accounts for producer groups, for business-oriented groups, which are promoted under day NRLM. And transactions through self-help group accounts are encouraged to use. So basically, these groups are encouraged to use savings and cash credit accounts regularly, including digital and banking correspondent agent channels. Lending norms for self-help groups. So, who are eligible for the loans? At least those self-help groups which are at least 6 months of 6 months of active existence is there. So, for a minimum of 6 months of active existence should be there. They are practicing Pancha Sutras, meaning to say regular meeting, regular saving, regular lending, timely repayment, and update books of accounts. So, they are practicing these 5 principles. They must qualify for grading norms of NABARD, and loans are given in multiple doses depending on self-help group performance and their repayment history. So cash credit limit is divided into different years. For first year, 6 times of the corpus can be provided. For second year, it is 8 times the corpus. For third year, minimum 6 lakhs based on the microcredit plan, and for fourth year onwards, above 6 lakhs can be provided. With respect to term loan, again, first dose can be up to 6 times of corpus or minimum or 1 lakh, whatever is minimum. Then second dose is 8 times, third is 6 lakhs based on plan and repayment history, and in the fourth dose, again, above 6 lakhs can be provided. What is the purpose of these loans? So these loans are provided mainly for productive purposes, for income generating activities, but they can also cover the main purpose. Do remember is productive purpose. So basically income generation, but they can also cover social needs, debt repayments, house construction, business livelihood. business or livelihood transactions. And again, the repayment schedule can vary between anywhere to 24 to 84 months. So it can vary to 2 to 7 years depending on the dose and the cash flow. So for first dose, it can be 2 years to 3 years. For second, 3 to 4. Third, 4 to 5, and for fourth, it can be anywhere between 5 to 7 years. Repayment can be monthly or quarterly installments, and interest rate is capped at 7%. There's no collateral or no margin required for loans up to 10 lakhs, and for 10 to 20 lakhs, again, there's no collateral, but they should be covered under credit guarantee for micro units, CGFMU for short. The defaulters, if willful defaulters are not eligible for the loans, but if only one member defaults, the entire self-help group does not become ineligible. The self-help group is not denied of a loan just because one of the member was defaulter. Post credit and monitoring. So after giving loans, bank must ensure proper follow-up so that money is used effectively and repayment happens smoothly. So bank should issue loan passbook or statements in the local regional languages to self-help groups so that the members can easily understand the loan details. Each bank should fix 1 or 2 days uh, in every 2 weeks when staff visit self-help group meetings in the villages. So this helps bank directly to interact with borrowers and solve problems to guide them. Then for recovery of loans, they maintain personal contact with the self-help group members and remind them of repayment. They conduct joint recovery camps. To strengthen rural credit, some bank officials may be deputed in state rural livelihood missions. This ensure closer cooperation. Supervision and monitoring is there. So banks should set up a special cell at their regional zonal offices, and this cell will monitor credit given to self-help groups to review repayment plans to ensure that credit support reaches the intended beneficiary. Support to the bankers. So state rural livelihood mission also support banks to make the credit system more effective. So their support includes forming strategic partnership, creating a supportive environment, helping self-help groups with financial literacy and counseling, and assisting banks in improving the quality of services. In this community-based repayment mechanism, so repayment responsibility is not left only to the banks. At village, cluster, or block levels, special communities may be formed to help the banks. And these communities ensure loans are used properly and repayments are made on time. This creates a sense of collective responsibility where the whole community helps in managing the loan discipline. Hmm. Then we have interest subvention for women self-help groups. Now, this is a special scheme to reduce the burden of interest on women self-help groups. For selected districts, 250 districts were selected, and all women self-help groups are eligible for interest subvention on loan up to 3 lakh of rupees. A bank must lend at 7% per annum to these groups. If bank's actual lending rate is higher, they are compensated for the difference up to 5.5%. And if self-help groups repay on time, they get additional 3% interest subvention. This means effectively the loan they get is only for 4% per annum. Then there are category 2 districts. So bank can lend at their normal rate in these other districts. The difference between bank's lending rate and 7% is directly paid by the state livelihood missions into self-help groups loan accounts. So self-help groups must repay promptly to avail this benefit. This is the condition. Then there's prompt repayment conditions for cash credit accounts. Our balance should not exceed the sanction limit for more than 30 days continuously, and there must be regular transaction in the account with at least one customer deposit each month. For term loans, all EMIs and interest must be paid with 30 days of the due date throughout the loan. Mission Shakti. So this is Women Empowerment Program of Odisha. So women's economic independence is closely tied to their social empowerment. The government of Odisha launched Mission Shakti in 2001 with the aim of empowering women through self-help groups. The program focuses on economic independence for women through self-employment and income generation, providing credit, and over time more and more women are encouraged to join women self-help groups. So this mission is all about building strong women group, giving them financial support and helping them becoming economically self-reliant. Deen Dayal Antyodaya Yojana National Urban Livelihood Mission. So what NRLM was doing, this is for urban areas, that was for rural areas. So earlier there was a scheme called Swan Jayanti Shehri Rozgar Yojana. So this scheme replaced that Swan Jayanti Shehri Rozgar Yojana, and in February 2016 it was replaced with a new mission called NULM, National Urban Livelihood Mission. So in 2016 this Swan Jayanti Shehri Rozgar Yojana was replaced, and the scheme was renamed to Deen Dayal Antyodaya Yojana National Urban Livelihood Mission. It mainly focuses on helping poor people in urban areas to improve their livelihood and to become self-reliant and reduce the poverty. Now it has five key components. Number one, social mobilization and institution development. Uh, Basically to create and strengthen self-help groups and their federations. Then training is provided, capacity building and training. So training and skill development for urban poor is there. Employment through skill training and placement are basically to train the youth for jobs and helping them get placed. Self-employment program, so it provides loan subsidies and support for individual or groups to start small businesses. And there is support to urban street vendors, so helping vendors with credit, license, space and livelihood security. Now the objective again is very clear: to provide the financial assistance to the poor who is living in urban areas, to help self-help groups to get easy loans and get interest subsidies, to provide technology, marketing and other support, to promote credit cards for working capital needs, and to encourage small businesses that matches the local demands. The beneficiary proportion in this scheme is that women should get minimum 30%, SC/ST gets at least equal to their share in the town's population, differently abled persons get 5%, again priority is given to the women, and minority communities get 15% of the targets reserved. How do we select beneficiaries? So who identify beneficiaries? They are identified by the community organizers, urban local bodies, self-help groups, area level federations, banks, business facilitators, business correspondents, or the beneficiaries themselves. Application process is simple. The applicant submits form to the ULBs, urban local bodies. Urban local bodies verify their identity. A task force at urban local body check the experience, skill, viability of the project and interviews the applicant. They recommended the applications and then send it to the banks, and bank must process them within 15 days. Now direct applications to the bank are also allowed as per PM Mudra Yojana guidelines. Education and training. So there's no minimum education qualification needed. If the proposed activity needs a special skill, then the beneficiary must get trained first. There are different types of training. So employment can be through skill training and placement. Entrepreneurship training is there. Follow-up entrepreneurship support is provided. And there is a pattern of financial assistance. So assistance is mainly through interest subsidy on bank loans. If loan is repaid on time, then the interest above 7% is subsidized. Women self-help groups again get an extra 3% interest subvention if they repay on time, and bank credit this subsidy directly to self-help group account. Then they can claim the reimbursement. Individual enterprises. So the minimum age for individual entrepreneurs prices in SCP-1, the loan and subsidy is 18 years, and the maximum project cost can be 2 lakh rupees. There's no collateral needed. Asset finance are charged to the bank, and they are covered under a credit guarantee scheme. The repayment period varies from 5 to 7 years, and a moratorium of 6 to 18 months is provided. For margin, no margin money is taken for loans up to 50,000 rupees and above 50,000 rupees for higher loans. it is 5% and maximum 10% of margin money can be set aside. What type of loans are provided? So, term loans, cash credit, and composite loans are provided. Term loans for capital expenditure, cash credit for working capital needs, and composite loan, it is a combination of both. Then, group enterprises, SCPG, loan and subsidies. So, at least three members should be there, with 70% of the urban poor families, not more than one from the same family. Keep that in mind. Minimum age again 18 years, maximum loan 2 lakh per member or total of 10 lakh rupees, whichever is less. Mode of loan can be single loan to the group or individual loans. Again, type of loans can be term loan, cash credit, or the composite loan. Margin money same as individual, none up to 50,000, 5 to 10% for higher amounts. No collateral is required. Assets financed are charged to the bank, guarantee from CGT MSE. Repayment again 5 to 7 years with a moratorium of 6 to 18 months. Just a minute. Yeah. Let's talk about the other provisions. So, self-help group bank linkage is there. So, follow RBI self-help group bank linkage guidelines. And we will cover it, self-help groups, we will cover it in unit number 41. And it helps self-help groups to get access of bank loan easily. Credit card for entrepreneurship development. So many small entrepreneurs need short-term funds for buying raw material goods. Often they depend on money lenders who charge very high interest rate. And to solve this, the scheme Deep Dayal Antyodaya Yojana, National Urban Livelihood Mission, provides credit card or Mudra card, sorry, through banks. The limits and norms are decided by the state urban livelihood missions and state level bankers committee. Now, technology and marketing supports are provided. So, city livelihood centers are set up under DAY NULM. These centers provide support in business registration, license, legal services, production, procurement, technology, packaging, marketing, sales. So, all these technology, marketing, other supports are provided by city livelihood centers. Then, loans are categorized under non-farm sector loans. A unique code is used for day NULM loans, and then there are subcodes like SCP1, SCPG, self-help group, women self-help group to ensure the proper tracking. Now let's talk about a very famous again Yojana, Pradhan Mantri Jan Dhan Yojana. So Pradhan Mantri Jan Dhan Yojana is a flagship financial inclusion program launched by the Government of India. Its main aim to ensure that every adult in the country has access to a bank account and related financial services like savings, credit, insurance, pension, money transfer. Now let's talk about the key features. Now this no minimum balance required to open and maintain the account. RuPay debit card is provided to the account holder. Insurance benefits are also provided. So accidental insurance of 1 lakh rupees for accounts which are opened after 28th of August 2018, and the coverage has been increased to 2 lakhs. So 2 lakhs after 28th of August 2018, and prior to that 1 lakh rupees. Life insurance of 30,000 is provided, which is linked to the RuPay card. Uh, for accident insurance claim, at least one financial or non-financial transaction using the card must be done within the 90 days of the accident. So keep that in mind. It's a condition which is attached. Easy money transfer is provided via these accounts, and direct benefit transfer uh, to the account happens with the help of Pradhan Mantri Jan Dhan Yojana. So, government subsidizes and benefits are directly credited to these accounts. Overdraft facilities provided after successful operations of account for 6 months. An overdraft loan can be given. And account holders become eligible for schemes like Pradhan Mantri Suraksha Bima Yojana, Atal Pension Yojana, Mudra loans. So they can easily access other schemes because they are now into the financial system. Formal economy has been introduced. Overdraft facility. The overdraft facility allows low income families to get small loans to meet the emergencies. Account must be a basic savings bank deposit account and operations must be for at least 6 months. So satisfactory operations must be happening for at least 6 months. Overdraft is usually granted to the earning member of the family. Accounts must have regular credits. Account holder should not have another savings bank account and Aadhaar should be linked to the account. There's an age limit which is there to avail the overdraft facility, which is 18 to 65 years of age. The maximum overdraft facility that can be provided is 10,000, which is again subject to certain conditions. There's the limit is that four times the average monthly balance in the last 6 months or 50% of total credits in the last 6 months. Again, maximum of 10,000. Loan period can be 3 years, so 36 months, which is renewed annually, and not more than 2% above the bank base rate can be charged as interest. No processing fees is charged, and only one family member can avail the overdraft facility. Pradhan Mantri Suraksha Bima Yojana. So it is a low cost accident insurance scheme which is launched for all citizens in the age group of 18 to 70 years. Any person with a bank account who gives consent to join uh, by 31st May each year is eligible for the scheme. The coverage period is 1st of June to 31st of May. The coverage period is 1st of June to 31st of May and it is renewable every year. Aadhaar is the primary identification document. The risk coverage for accidental death or permanent total disability is 2 lakh rupees and 1 lakh for partial disability. Premium is 20 rupees per annum only, and the mode of payment is that premium is auto debited once a year from the bank account. Public sector, general insurance companies, and other approvers in partnership with the banks can be the insurance providers, and this scheme gives a financial safety net to the poor and low income groups against the accidental risk at a very affordable cost. Now let's talk about Atal Pension Yojana. Atal Pension Yojana was launched on 9th of May 2015 to provide a pension system for unorganized sector workers like daily wage earners, small shopkeepers, low income individuals, and it is regulated, it is managed by Pension Fund Regulatory and Development Authority PFRDA. So, all bank account holders aged between 18 to 40 years are eligible for this pension scheme. Monthly contribution vary on the pension amount chosen. So, it can vary between 1,000 to 5,000 per month after age of 60. The earlier ones join the smaller contribution required. From 1st October 2022, person who are income taxpayers, they are not eligible for Atal Pension Yojana. Now, the subscribers will get 1,000, 2,000, 5,000 per month after turning 60 years of age. So, it provides guarantee monthly pension of 1 to 5,000 depending on the contributions. And after the subscriber's death, the spouse will continue to receive the pension, and after both die, the accumulated pension corpus is paid to the nominee. If the pension fund earns less than the expected returns, the government will make up for the shortfall to ensure the promised pension. If returns are higher, then the subscriber will get the higher benefits. And if the subscriber dies before 60 years, the spouse can continue the contributions until what would have been the subscriber's 60th birthday. Let's talk about Mudra Yojana, Pradhan Mantri Mudra Yojana. Um, the origin happens in April 2015. The government launched Pradhan Mantri Mudra Yojana, and to implement this, Mudra Limited was set up. So, Micro Unit Development and Refinance Agency Mudra for short, it was set up. Its main aim is to help micro and small businesses to get the financial support. The objective and the function of the Mudra, let's talk about it. So, to provide support to entrepreneurs and businesses by refinancing loan given by banks, NBFCs, and microfinance institutions. So, it acts as a monitoring agency for Pradhan Mantri Mudra Yojana loan through a central web portal and provides guarantees for loans so that banks feel confident in lending. Now, there are three types of Mudra loans: Shishu, Kishore, Tarun, and recently there's Tarun Plus also. Uh, For Shishu, it is up to 50,000. For Kishore, 50,000 to 5 lakh. For Tarun, it is 5 to 10 lakhs. And then currently there is Tarun Plus as well, which provides loan of 10 to 20 lakhs. So this limit has actually been raised from 10 to 20 lakhs. So who can apply? If any individual, any proprietor, small business entrepreneurs, they can apply, but the main condition is that they must not be a defaulter with any bank. They should have a good credit record and must have necessary skills, experience, knowledge to run the business, and education qualification may be required depending on the business type. Loans can be given only for income generating activities. Keep that in mind. The purpose of loan should not be for personal spending, and they can be used for buying machinery, tools, working capital. But again, the purpose should be interest generating activities. A Mudra card is issued for easy use of the working capital. A bank may ask the borrower to contribute the part of the project. So, a margin can be asked for except for Shishu loans. As per bank's own policy, interest rate can be charged, and for refinance cases, Mudra advises the rate. Processing fees are normally charged, but Shishu loans have no processing fees in most banks. With respect to security, so bank take a charge on the business assets created out of loan. There is no collateral security required, and it is covered under credit guarantee fund for micro units, which reduces the bank risk. With respect to repayment, tenure depends on the life of the asset and expected cash flow for businesses. Term loans are repaid in installments with a moratorium. Moratorium is a holiday period. Uh, OD facility, OD limits, and cash free limits are repayable on demand, and Mudra refinance is generally up to 36 months. It is generally up to 3 years. Khadi Village Industry Commission. So, Khadi Village Industry Commission is a statutory body which is created in 1957 to promote Khadi and village industries. Its key goal are social, economic, and wider. So, social is create employment, economic is produce goods that can be sold in the market, and wider encourages self-reliance and strengthen rural communities. The function includes to run programs to develop khadi and village industries, to maintain reserves of raw materials and provide them to producers, to set up common facilities for processing raw material, provide marketing support, and to train artisans and provide financial support for rural industries. Pradhan Mantri Employment Generation Program. So it was started in 2008 by merging Pradhan Mantri Rozgar Yojana and Rural Employment Generation Program. It is revised and it is currently active from 2021, 22 to 2025 to 26. It is a credit linked subsidy scheme. Implementing agency uh, are divided into three levels: national, state, and other partners. So, at national level, CAIIB is the nodal agency. At state level, state CAIIB directorates and other partners. So, the COIR board should be public, private, cooperative banks are the partners. The objective is simple: to generate self employment opportunities and promote micro enterprises, to provide jobs to the artisan, to stop migration from rural to urban areas by creating jobs in the village itself. Beneficiary identification is done at district level. The applicants undergo 2 weeks of training in entrepreneurship and vocational skills. For bank link cases, Indian Banks Association scoring model is used. With respect to financial assistance, so there's a margin money subsidy which is provided for general categories. 15% of subsidy is provided in urban areas and 25% in rural areas. But then there is a special category: SC, ST, OBC, minority, women, differently able person. So 25% subsidy in urban areas and 35% subsidy in the rural areas is provided. There's upgradation of existing units. So a subsidy of 15% is provided normally, and 20% in northeastern state or hill areas. Beneficiary contributes 10% of the project cost. Project cost limits are there for manufacturing sector. For existing units, it is up to 50 lakhs. For upgradation, it is 1 CR. For service or business sector, it is up to 20 lakhs for new units and 25 lakhs for upgradation. If the project cost exceed this, then the bank can still fund the balance without providing any subsidy. who are eligible. Minimum age should be 18 years. Minimum qualification should be 8 standard for projects above 10 lakh rupees in manufacturing or 5 lakh rupees in service. There is no income ceiling and one person per family can avail for these loans. What is the eligibility criteria for the project? So only new projects are eligible. Land cost is not included. Keep that in mind. Project must be viable and should not be in a negative list. For upgradation, earlier loans must be repaid and the unit must be profit making unit. Banks provide a general loan of 90% and for special categories, bank may go up to 95%. Nature of facility can be term loan, working capital or the composite loan. Working capital should not exceed 40% in the manufacturing sector and 60% in the service sector. Interest rate is as per the bank's policy. Repayment is 3 to 7 years after moratorium period. No collateral is required for loans up to 10 years and loan decisions must be given within 30 days. There is an online process flow. So applications to be submitted online at Pradhan Mantri Employment Generation Program portal. Beneficiaries must score minimum marks. So it is 50 marks for projects up to 10 lakhs and 60 for higher projects. Loan sanctioned or rejected online should be done within 30 days. Subsidy is credited to the bank and is kept in subsidy reserve fund for 3 years. And if unit fails, subsidy is returned to CAIIB. Now let's check your progress. National Rural Livelihood Mission replaced which Yojana? It replaced Swan Jayanti Gram Swarajgar Yojana. So D is the correct answer. Under NRLM, a woman SHG is eligible for it. They are eligible for interest subvention, not for capital subsidy, and up to 3 lakh rupees. Again, D is the correct answer. Under SCPG of NULM, a bank will sanction maximum loan of dash per individual or maximum dash for a group, whichever is lower. It is 2 or 10, 2 lakhs or 10 lakhs. So A is the correct answer for this question. Under Pradhan Mantri Jan Dhan Yojana, the limit of for overdraft facility is dash and it is availed to dash members of the household. It is 10,000 and one member. So D is the correct answer for this question. Now let's do some practice questions. Consider the following statements about Deen Dayal Antyodaya Yojana National Rural Livelihood Mission. Day NRLM aims to promote poverty reduction through building strong institutions of the poor. This statement is correct. C gets eliminated. Let's read statement number 2. Participatory identification of poor exclude the use of SECC data. It is actually uses this data. It includes the use, not exclude the use, and hence 2 is not the correct answer. Now let's read statement number 5. Only women from rural households are allowed to participate. So they are prioritized, but not only a woman can participate, men can also participate, and hence B is the correct answer for this question. Consider the following statements regarding SHGs under Day NRLM. Identify which of the following statements are correct. The Community Investment Support Fund is provided universally to all self-help group across India, irrespective of block categorization. No, only to intensive blocks it is provided, not universally, not correct. Hence, we can safely eliminate option A and B. Now, let's read state number 2. Self-help groups must be active for at least 12 months. They should be active for 6 months, not 12 months. Hence, 2 is not correct. We get our correct answer. Correct answer is D. Consider the following statements regarding the loan structure and usage guidelines under Deen Dayal Antyodaya Yojana National Rural Livelihood Mission. In the first year, the cash credit limit drawing power must be fixed at 8 times the existing corpus or minimum 1 lakh, whichever is higher. So it is 6 times and not 8 times, and hence 1 is not correct. So A and B gets eliminated. In the fourth year under the term loan system, the amount sanctioned must necessarily be exactly 6 lakhs regardless of MCP. So it is not fixed at 6 lakhs. It may go above 6 lakhs based on MCP or the credit history, and hence this statement is not correct. So we'll get our answer. C is the correct answer for this question. Evaluate the following statements regarding DAY NRLM, self-help group bank linkage guidelines, and identify which statements are correct. For loans up to 10 lakhs, the bank may insist on deposit or mark a lien on self-help groups savings account. So no margin is required, no collateral is required for loans up to 10 lakh rupees, and hence statement 1 is not correct. So safely eliminate option B and D. There is no need to read statement number 2. It is common in both the statement. 3 is not there. Let's skip statement number 3. Let's read statement number 4 and we'll get our answer. Interest subvention of 3% on prompt repayment is available only in category 2 district. It is available in category 1 district and not category 2 district. Right. So 3% of additional subvention on prompt repayment is applicable in those selected 250 districts, right? Not only in category 2 districts. So hence this is not correct. And we get our answer. A is the correct answer for this question. Which of the following statements are correct regarding Deen Dayal Antyodaya Yojana, National Urban Livelihood Mission? The NULM provides financial assistance to individuals and groups through both direct loans and loan facilitated by banks with interest subsidies for timely repayment. So this statement is correct and hence we can eliminate option number D. Uh, let's read statement number 2. At least 50% of the financial assistance must be allocated to beneficiaries from SC/ST. So the proportion of financial assistance is not set at 50%. It is based on the proportion uh, of them in the city or the town's population. So it is not fixed at 50% and hence 2 is not a correct statement. Let's read step number 3. One of the key objectives of self-employment program is to support urban street vendors by providing them interest-free loans. So it is not interest-free loans, rather interest subsidies are provided for the loans. Hence, this is not correct and B is the correct answer for this question. Which of the following statements regarding NULM scheme are accurate? Meaning to say, which of them are correct? So the maximum unit project under SCP-1 is capped at 2 lakh rupees, which include both working capital and capital expenditure components. So it is correct. So 1 is correct and hence B and C gets eliminated. There is no need to read statement 3, statement 2 and we'll get our answer. Under SCPG scheme, the loan amount per member is restricted to 2 lakh with a total group ceiling of 12 lakhs. So no, per member is 2 but total is 10 not 12 and hence this is not correct and we'll get our answer. Option A is the correct answer for this question. Ravi, a 35-year-old man, lives in rural area and has been working as a daily wage laborer for past 5 years. He does not have a bank account and has never availed any government scheme. His monthly income varies, but he receives some payments through DBT scheme for government subsidies. Recently, Ravi heard about Pradhan Mantri Jan Dhan Yojana and decided to open a bank account. Now, you have to tell which of the following statements are correct. Ravi can open the account without maintaining any minimum balance, correct? So, even if we have not read statement number 1, it will have not harmed us. Again, step number 2 is there present in every option. Ravi can be eligible for maximum overdraft of 20. No, the limit is 10,000 and hence 3 is not correct. So, we can now safely eliminate 2 options. Let's read step number 4. To avail the overdraft facility, Ravi must ensure that his account is linked with Aadhaar. So, this is correct. So, statement number 4 is correct and hence option D is the correct answer for this question. Identify the correct statement about Pradhan Mantri Suraksha Bima Yojana and Atal Pension Yojana. So, Pradhan Mantri Suraksha Bima Yojana provides this coverage of 5 lakhs for accidental death. It is 2 and not 5 and hence A and D gets eliminated. Atal Pension Yojana is only available to people who are income taxpayer. It is not uh, available to people who pays income tax. So, 2 again is not correct and hence we get our answer. C is the correct answer. 3, 4 and 5 are correct. Consider the following statements about Mudra scheme. Mudra was set up in April 2015 and operates under Pradhan Mantri Mudra Yojana. So this is correct. So 1 is correct. So B is eliminated. Maximum loan amount, it is 20 lakhs now, not 5 lakhs. So it was never 5 lakhs. It was 10 lakhs and now it has been changed to 20 lakhs. So 2 is not correct. So let's see step number 5. Banks may charge processing fees for loans under Shishu scheme. No, this is not correct. And hence we get our correct answer. A is the correct answer for this question. Which of the following statement regarding KVIC and Prime Minister Employment Generation Program are correct? It was established in 1960, no, established in 1957, not 60. So one gets eliminated, and that's why A and D we can safely eliminate. The primary economic objective is to create self-reliance among the poor, not to provide the employment. The primary economic objective is producing sellable articles and not just creating the self-reliance. So, 2 in a way is not correct, and hence we get our correct answer. C is the correct answer for this question. In this particular unit, we'll understand why do we need self-help group, what is an self-help group, uh, self-help group and bank linkage program. We'll check your progress, we'll do some practice questions, and we'll wind up this class. So let's begin. So a self-help group is a small voluntary group of people, basically poor people, who come together to help each other socially and financially. So they work with a common goal to improve their lives. You can think of it like a group of neighbors pooling money and skills so that no one is left behind. For example, in a village, 12 women met every week. Each woman saved 50 rupees. So this money is kept in a joint account. One day, a member wants to buy a sewing machine. So the group gives her a loan for from these savings, and she earns money from tailoring and repay the group. Now, why do we need self help groups? So, individually, poor people often face many problems like low income, less education, they don't have any access to the bank, and low confidence as well. So, but in a group, they become stronger. Together, they can collect money for common needs, improve living standard, build saving habits, share their skill set with each other, give loan in emergencies, start small businesses, solve problems as a team, and organize training to learn new skills. So, in this manner, they get benefit from this group. Forming self-help groups, how are they formed? So, normally, usually 10 to 20 members are there in a group, but in remote areas, even 5 members is fine. They can form a self-help group, and they mostly belong to below poverty line families. A small number can be slightly above poverty line, but living nearby. And only below poverty line members get the subsidies, and these members, below poverty line members, must lead and take decisions. Above poverty line members cannot be group leaders, and only one member from each family can be a part of the group. And a person cannot join more than one self-help group. The group makes its own rules for meetings, savings, and loans, and members save regularly to build a common fund. Loans are given from this fund, and the group opens a bank account in the local branch. Uh, they maintain records, so simple records are kept like meeting notes, attendance, savings, and loans. So these all records are maintained by the group. Self-help group bank linkage program. The Reserve Bank of India encourages banks to work with self-help groups so they can get loans and saving facilities. So any self-help group, registered or not, doesn't matter, can open a savings account if it promotes savings. Banks give loans linked to group savings. Uh, Bank may give 1 to 4 times to that amount. So if, for example, if a group saves 10,000 rupees, they can get a loan up to 40,000 rupees. So bank can give a loan in the ratio 1:4, one times savings, 4 times loans. And mature groups can get even more. So bank decides the interest rate within RBI guidelines. There is no processing or inspection fees for loans up to 25,000 rupees per member under priority sector lending. If the group as a whole is not in default. A few individual defaulters will not stop the loan, and banks should train their staff to work with self-help groups. Progress is reviewed in every official meeting, and loan details are reported to CICs, credit information companies. Now let's check your progress. Maintenance of which of the following books register is not compulsory for self-help groups. So minutes book they maintain, savings and loan register they do, members passbook they maintain. So visitor book, so this is not compulsory. So C is a correct answer for this question. Bank lending to self-help group can usually be maximum in the ratio. It is from 1 is to 1 to 1 is to 4. So A is the correct answer for this question. Now let's move on to practice questions. Consider the following statements about self-help groups. Self-help groups help in mobilizing individual resources for collective development. So this statement is correct. Self-help groups provide a platform for identifying problems, analyzing them and finding solutions. Again correct. Self-help groups eliminate the need of for savings among rural poor by providing grants. No, this statement is not correct. So statement 1 is correct, statement 2 is correct, making option A as the correct answer for this question. Let's move on to next question. Which of the following statement about self-help group formation guidelines are correct? Self-help groups must have a minimum of 10 members. So this is not true in every scenario, because we have just discussed that a group can be formed with as few members as 5. So minimum of 10 members, not correct. A person can be a member of more than one self-help group. No, this statement is not correct. Self-help group should not have more than one member from the same family. This statement is absolutely correct. APL members are not allowed to be office bearers in the group. Again, this statement is correct. Self-help groups are encouraged to create their own group management norms. So this statement is also correct. So statement 3, 4 and 5 are correct, making option C as the correct answer for this question. Which of the following statements regarding self-help groups and their bank linkage is or are correct? Self-help group must maintain complex and detailed records like audit reports and financial statement. No, they must maintain simple records, not these complex records. So this statement is not correct. Basic record like minutes, book, attendance register, they can maintain. Self-help group can open savings bank account with banks whether registered or not. So this statement is correct. Banks can sanction loan to self-help groups based on a saving to loan ratio of 1 is to 1 to 1 is to 4. Again, correct. No service or processing charges are applicable to loans up to 50. No, it is 25. Hence, not correct. Banks are required to internalize the self-help group linkage project and provide training programs for field level functionaries. Again, this statement is correct. So 2, 3 and 5 are correct, making option A as the correct answer for this question. I hope everything is clear to you. But again, if you have any doubts, please don't hesitate to reach out to us on our Telegram group channel, JIB CIB Prep. We'll start Module C from next class. See you then. Please revise and take care.